Hello my dear CA Inter aspirants. Welcome to the first video of past exam question series. And today we are solving July 2021 examination question paper after considering all amendments for your May or November 2022. So in this video, I'm only covering descriptive questions. And each and every adjustments, every working notes, every other notes, explanation, etc. will be detailedly covered in this particular video. So friends, without wasting time, let's get started. Okay friends, so let's start with question number 1. So Mr. Anish, a resident individual aged 43 years. So he's basically a individual and his age is 43 years, provides professional services in the field of interior decoration. So he's a interior decorator as well. His income and expenditure account for the year ended 31st March 2022 is as under. So friends, this is actually your July 2021 exam. But for your May or November 2022 examination attempt, the relevant previous year would be 2021-22. And while solving this particular question paper, I have considered all the amendments for your May or November 2022 attempt. So you don't need to worry about the amendments. All right. So let's continue with the question. Expenditure side is there. In the expenditure side, there is employees remuneration and benefit is given, that is 13,66,000. Then office and administration expenses is given. Then general expenses are given, electricity expenses given, medical expenses given, purchase of furniture is given, depreciation is given, excess of income over expenses is also given. In the income side, they have given consultancy charges, then interest on public provident fund is given, then interest on savings bank account is given, then interest on national savings certificate 8 is also given. Now, the following other information relates to the financial year 21-22. So there are some further information also in the question. So starting with the first information, it is the expenses on employees remuneration and benefit includes. It says family planning expenditure of 20,000 incurred for the employees, which was revenue nature, and the same was paid through account paycheck. All right. Then payment of salary for 25,000 per month to sister-in-law of Mr. Anish, who was in charge of accounts and receivables department. However, in comparison to similar work profile, the reasonable salary at the market rates is 20,000 per month. Then they are also saying amount received by Mr. Anish as employees contribution to employee provident fund for the month of February 2022, rupees 10,000 was deposited after the due date under the relevant act relating to EPF. Then they are also stating that medical expenses of 80,000 as appearing in the income and expenditure was expended for the treatment of father of Mr. Anish, and his father was 72 years old and was not covered by the health insurance policy. The said payment of 80,000 was made through account pay check. Now, the general expenses as appearing in the income and expenditure account includes a sum of 25,000 paid to Angeline on 5th January 2022 as commission for securing work from new clients. This payment was made to her without deduction of tax at source. So it's in relation to some TDS. Now, the written down value of the depreciable asset as on 1st April 2021 were as follows. Professional books, computers, then the furniture, professional books and computers, that's it. Then they are also saying new furniture was appearing in the income and expense account was purchased on 31st August 2021 and put to use on the same day. The payment was made under 18,000 paid in cash at the time of purchase of new furniture, 19,000 paid by account pay check on 5/9/2021 as balance cost of the new furniture, and 11,000 paid in cash on 31st August 2021 to the transporter as freight for the new furniture. All right. And they're also stating Mr. Anish purchased a car on 2nd April 2020. This is actually 2020. Yeah, for 3,35,000 for personal use. So let's make it 2000. Yeah, it is 2020 only. It's right. 2020 for 3,35,000 for personal use. However, on 30th April 2021, he bought the car. He brought the said car for the use in profession, and the fair market value of the car as on 30th April 2021 was 2,50,000. So this car was purchased in the preceding year and it was using for his personal purpose. Thereafter, he brought that particular car into his business in the relevant previous year, that is 21-22 of this question. All right. Now, Mr. Anish was made a contribution of 1 lakh in public provident fund account on 31st January 2022. And his gross professional receipts of Mr. Anish for the previous year 21-22 was 52 lakh. So his gross professional receipts is also given. Now, what is the requirement of the question? Compute the total income and the tax liability of Mr. Anish. So you are supposed to compute the total income and tax liability of Mr. Anish for the assessment year 22-23, assuming that he has not opted for payment of tax under 115 BAC. That means the new parallel slab rate is not applicable. We must compute the total income as per the normal provision, and we need to compute the rate of tax also as per the normal provision, because in this question assessor is not interested in taking the new parallel slab rate which is mentioned under 115 BAC of income tax. Alright, now they are also stating a note, ignore the provisions of AMT. That means you don't need to consider alternate minimum taxes, and 14A relating to disallowance of expenditure incurred in relation to income not included in the total income. All right, so this question carries around 14 marks. All right, so this is the first descriptive question of your June 2021 examination, and it carries 14 marks. So friends, let's start answering this particular question. So there are a lot of informations given. Now, from where to start? So question like this, you always start from the excess of income over expenses, that is this 39,43,000. That should be our starting point. So friends, we will write it in a proper format, computation of total income of Mr. Anish for the year 2021-22. All right, so we will start with a net profit in the question. So friends, what is the net profit given in the question? So the net profit given in this question is 39,43,000. That is the net profit given in the question. So 39,43,000 is the net profit in the question. Now, we will read each and every further adjustments. So the first additional adjustment says that expenses on employee remuneration and benefit includes. So that means this employee remuneration and benefit includes what? A family planning expenditure of 20,000 incurred for the employees, which was revenue in nature, and the same was paid through account paid check. So friends, under section 32, it says that if an employer incurs family planning expenditure among his employees to promote the family planning, if an employer incurs any expenditure to promote family planning among their employees, he is eligible to claim it as a deduction. And as you know, there are two types of family planning expenditure, or we can say family planning expenditure can be deducted or can be categorized into two. Number one, revenue nature family planning expenditure. This revenue nature family planning expenditure can be claimed as a deduction under section 36 in the year of expenditure itself. And if the expenditure is in nature of capital, then the family planning expense is claimed as a deduction in 5 equal annual installment. Hope you remember section 36. But friends, there is a restriction under section 36. It says that for claiming deduction under this family planning expenditure, the assessee should be a company assessee. Only company assessees are eligible to claim family planning expenditure, whether it is revenue or whether it is capital, as a deduction under section 36. So now friends, you tell me, Mr. Anish is a resident individual. He is not a company assessee. He is an individual assessee. And hence we can say he is not eligible to claim this 20,000 as a deduction from as a deduction under section 36. But in the P&L, this 20,000 has been deducted from the profits. So what we need to do? We need to add back this 20,000 back to the profit to arrive at the correct profits, which is taxable under PGPP head. All right. So the first adjustment is add back family planning expenditure. All right. So this is the first adjustment, family planning expenditure. Since assessee is not company SSA, he is not eligible to claim it as a deduction. Alright, so he's not eligible to claim this expenditure as a deduction. So we are adding back the 20,000 to the profits of SSCs. That is the first adjustment required. I hope it is clear to you. Alright, now moving on to the second adjustment, that is B. So we have done with the first one. Second one is payment of salary 25,000 per month to sister-in-law of Mr. Anish, who was in charge of accounts and receivables department. So Mr. Anish has paid some salary to sister-in-law for who is in charge of accounts and receivables department. However, in comparison to the work profile, reasonable salary at market rate was only 20,000 per month. So the reasonable salary as per the market rates was only 20,000 per month. Alright, so this is covered under section 48.2. Hope you remember, under PGBP there is a disallowance and the section number is 48.2. It states that if an assessee pays excess expenditure to his relatives, then the excess portion should be disallowed under 48.2. Alright, so if an assessee is paying what? Excess expenditure to his relatives, that excess portion is disallowed under 48.2. That's what the section states about. Alright friends, under section 48.2, relative means. So I will write the working notes over here. So under section 48.2, relative means. Who are relatives under 48.2? It says that husband, wife, brother, sister, lineal ascendant or lineal descendant. That means if you are an individual, say for me, my wife is my relative, my brother, my sister, my father, grandfather, lineal ascendant, my son, grandson, or my daughter, granddaughter, they are my relatives. Now the question is, in this question, Mr. Anish has made a payment to whom? To his sister-in-law. So under 48.2, sister-in-law is not a relative. That is the first thing that you should know. Sister-in-law is not considered as a relative under 48.2. If the payee is not a relative, then 48.2 will not be applicable, right? So 48.2 states that when one person makes a payment to his relatives and the payment which he made is over and above the fair market rate, then the excess over the market rate should be a disallowance. That's what 48.2 says. But the payee under 48.2 should be a relative, right? So relative definition means individual, his wife, brother, sister, lineal ascendant or descendant. Here, since the payment is made to sister-in-law, it is not disallowed under 48.2. So you have to write a note, payment to sister-in-law is not disallowed. Is not disallowed, or we can say excess payment to sister-in-law is not disallowed under 48.2. Why? Because she is not a relative. Because she is not a relative. That is the reason. So hence in this question, no further adjustment required. Why? Because that excess 25,000 per month salary is already there as a part of this employee's remuneration and benefits. So in this question, no further adjustment is required because the disallowance under 48.2 will not be applicable. I hope it is clear for you. Alright, so moving on to the third adjustment. So we have covered B also. So moving on to the third adjustment, that is not third adjustment, the actual second adjustment, right? So adjustment number 2, amount received by Mr. Anish as employee contribution to EPF for the month of February 2022. 10,000 was deposited after due date under the relevant act relating to EPF. So Mr. Anish has received some amount from his employees, all right, as employee contribution to the provident fund. But he made 10,000 rupees out of his total receipt from employees. 10,000 has paid to the PF account after due date of that particular act. Then what happens? Hope you remember, under section 36, when an employer deducts PF contribution from his employee salary, that contribution have to be treated as income under section 22410. Then later on, that particular employer who deducted the sum has to make payment to the PF fund within that act's due dates. That act's due date. What do you mean by that act due date? That means PF Act. So whatever the due date specified by the PF Act, within that due date, the employer must pay it to the PF fund. Now the question, what if the employer is not making that payment in time? If that employer is not making that payment in time, then he cannot claim that particular payment as a deduction under section 36. So what ultimately happens is, like, when the employer makes salary to the employee, he will deduct certain portion of the salary as what? As PF, as the PF contribution of the employee. Then he will collect that particular portion which is deducted from the employee salary, and he will make that particular or he will pay it to the PF fund. Within due date, he have to pay that amount to the PF fund within due date. If he haven't, then what happens? Then that particular amount which is deducted by the employer will be treated as his income, and he will not be eligible to claim it as a deduction. It states under section 36. So ultimately, what is the adjustment required in this particular question? Since employer haven't made that 10,000 within PF Act's due date, that entire 10,000 will be considered as his taxable income. Alright, so the adjustment required is, since employer haven't made payment to the PF account within due date, such employee contribution is treated as his income, and not allowed as deduction under section 36. All right, so how much is the sum, friends? So the sum which he haven't paid within due date is 10,000. So the 10,000 will be treated as his taxable income. I hope this much is super clear for you. All right. Now, moving on with the next adjustment, friends. What is the next adjustment? Medical expenses of 80,000 was appearing in the income and expenditure was expended for the treatment of father of Mr. Anish. His father was 72 years old and was not covered by health insurance policy, and the said payment of 80,000 was made through account paycheck. So first of all, this insurance or this medical expenses incurred for father of assessee is not a business expenditure. All right. It is allowable as a deduction under 80D. Hope you remember. All right. So those students who have covered or who have gone through my lectures, there are 4 categories under 80D. Hope you remember. Category 1 is expenses for family. Category 2 is what? Is for parents. Category 1 is actually medical insurance premium for the family. Category 2, medical insurance premium for parents. Category 3, actual medical expenses for family. And category 4, actual medical expenses for parents. So this particular 80,000 will be covered under actual medical expenses for parents category, that is category 4. All right. So those students who have followed my lectures, this will be clear for you. For others, please listen. This is very simple concept, friends. If under 80D, if a particular assessee's parent does not have any medical expenditure, does not have any medical insurance, then the actual medical expenditure he incurred is allowable as a deduction under 80D. That's it. All right. So let's do the adjustment in this question. So what we are required to do? We are required to add back this 80,000 from the net profit because it has been considered in the income and expenditure account. All right. So the first adjustment required is we need to add back medical expenses of father, since it is personal in nature. It's personal in nature, not allowed as deduction. So this 80,000 we need to add back from the profits. That is the first adjustment required. Then under chapter 6A, then under chapter 6A, 80D, this medical expenses which is incurred for the family is allowed as a deduction, but there is a restriction. His father, if he is a resident, plus senior citizen. If his father is a resident and senior citizen, maximum deduction allowable would be, how much is the maximum deduction allowable? It will be 50,000 rupees. So let's read that adjustment again. His father was 72 years old. So definitely he is what? He is a senior citizen. Now his residential status is not mentioned in the question. So if his residential status is not mentioned in the question, then we always have to assume that he is a resident. Because currently we are in India and we normally talk about the Indians, right? So if his residential status is not specifically mentioned in the question, always assume that he is a resident. That's it. All right. Now he is a resident as well as a senior citizen. So they have expended around 80. So what is the maximum deduction that they can get? The maximum deduction that they can get is 50,000 rupees. Even though the actual expenditure is 80, they are only eligible to get maximum 50,000 as a deduction. Hope that much is clear for you. All right. Moving on to the next one. It is general expenses as appearing in the income and expenditure account includes a sum of 25,000 paid to Miss Angeline on 25th January 2022 as a commission for securing work from new clients. So there was some commission paid. This payment was made to her without deduction of tax at source. So this payment has been made without deducting TDS. Okay friends, so what to do with this particular payment? So in the question at the end, they have stated that this particular assessee's gross professional receipts is 52 lakh in the previous year 2021. So in the question, the relevant previous year in the question is 2021-22. But in the question, they have stated his gross receipts in the preceding financial year. So what is the relevance of that preceding financial year gross receipts? So under TDS, to be very specific, under 194H, hope you remember, under 194H, in the case of a professional, while making any payment, if his gross receipts in the preceding financial year exceeds 50 lakh, then he need to deduct TDS for the commission which he paid for his business purpose under section 194H. All right. So we will write a note as well here. So under section 194H, an individual while paying commission for his professional purpose and the sum if exceeds rupees 15,000 and the sum if exceeds rupees 15,000 is required to deduct TDS at 5%. All right. Now at 5%, if his professional gross receipts in the preceding financial year exceeds rupees 50 lakhs. This is what 194H states about. So in the question, it is very clear that his professional receipts exceeds 50 lakh in the preceding financial year, that is 2020-21, and hence for the commission which he paid to Miss Angeline, he is definitely required to deduct TDS. All right. So there is a default in deducting TDS. So if there is a default in deducting TDS, then under section 40A1A, under section 40A1A, 30% of that commission amount will be a disallowance. So let's check what exactly is the commission amount. So in the question, the commission amount which they are stating is how much? It is 25,000 rupees. So 30% of 25,000 will be a disallowance. And the sum would be 25,000 into 30%. It would be 7,500 rupees will be a disallowance. So 30% of 25,000 rupees will be a disallowance. That will be 7,500 rupees. You have to add back to the net profit. Now, moving on, friends, moving on with the next adjustment, it says that the written down value of the depreciable asset as on 1st April 2001 were as follows. So they have given some written down value of depreciable assets. Now, before that, we need to check whether there is any depreciation already deducted in the P&L. Yes, they have deducted some depreciation in the P&L. So first of all, let's add back the depreciation. Why? Because since they have given the opening WDV to compute the depreciation, we need to compute the depreciation as per Income Tax Act, right? So let's check before deducting. Let's check what exactly is the depreciation coming on computation. So we will write depreciation under section 32 with a working note number 1. We will write a separate working note for that. All right. So let's compute the depreciation. So depreciation, that is working note number 1. So how to compute the depreciation? They have given the opening WDV of some of the assets, and it says that how much is the opening WDV for professional books. For professional books, what they are saying, it is 90,000 rupees. So books, you know the rate of depreciation, it is at 40%. At 40% is the rate of books, whether it is annual publication or not. So 90,000 into 40%, it will be 36,000 will be the depreciation for books. And for computers, the value which they have stated is 35,000. It is also depreciable at 40%. So 35,000 into 40% depreciation would be 14,000 rupees. So 35,000 into 40%, it is 14,000 rupees. All right. So these are the two depreciations which they are mentioning. So the total depreciation, and friends, there is one more thing before we concluding into total depreciation. They are also mentioning about a new furniture which was appearing in the income tax expenditure account, was purchased on 31st August 2021. So before moving on to the next adjustment, they are also saying there is a purchase of furniture in the P&L account. All right. So the entire purchase cost has been debited from your income and expenditure account. That treatment is fully wrong, right? So what we need to do, we need to add back that cost and we can claim depreciation on that purchase cost. All right. So we will compute the depreciation of furniture also. So there is a purchase of furniture, and the purchase value which is mentioned in the question, how much is the purchase value? It is 48,000 rupees. All right. And it is purchased on which date, friends? It is purchased on, let's check the dates. It is purchased on 31st August 2021 and put to use on the same day. So more than 180 days it has been used for in the year of purchase. That particular furniture is definitely used for more than 180 days as well. So there is no confusion in that. But they are also saying while making the payment, 18,000 was paid in cash. Again, 19,000 was paid by account paid check. And 11,000 is also paid in cash. So hope you remember, under determination of actual cost, Income Tax Act specifically states that if one assessee, while purchasing a capital asset, while making payment, if the single day payment exceeds 10,000 rupees, then the method of payment should be either account pay check, account pay cross check, or account pay bank draft, or electronic clearing system, or through prescribed electronic modes. And if a person is making the payment in any other mode, say for example in cash, in a single day payment exceeding 10,000, if he's making in cash, then that particular portion which he made in cash have to be removed from the actual cost for computing depreciation. Hope you remember this particular definition under actual cost determination. All right. So here the purchase cost, total cost was 48,000. Out of that 48,000, the question says that 18,000 paid in cash. So he made 18,000 payment in cash. And they're also saying 90,000 paid by account paycheck. That is fully okay. 90,000 paid by account paycheck is fully acceptable. No problem for that. 11,000 also paid in cash. Again, there's a payment in cash, that is 11,000 as well. So tell me friends, what is the remaining payment? From 48,000, you need to deduct this 18,000 cash payment and 11,000 cash payment, and the remaining would be 19,000. So this should be the actual cost. On this actual cost, we need to compute depreciation. And what is the rate of depreciation for furniture? It is depreciable at 10%. And the depreciation would be 1,900 rupees. All right. So now we can total the amount of depreciation, that is 36,000 plus 14,000 plus 1,900, and the total depreciation would be 36,000 plus 14,000 plus 1,900, and the total depreciation would be 51,900 would be the total depreciation. All right. So let's go back to the computation, and we are supposed to do a few adjustments. So the actual depreciation which we can deduct is 51,900, and we need to add back the depreciation as per books of accounts which is given, which has been debited in the income and expenditure account. And how much is the depreciation as per books of accounts, friends? It is 90,000 rupees. We need to add back this 90,000 rupees because it is already debited in the P&L account. And we need to add back the purchase cost of furniture as well. Purchase cost of furniture also we need to add back. And tell me friends, how much is the purchase cost of furniture? It is 48,000 rupees. That also is required to be added back to the net profit. Or you can adjust the net. Okay, instead of adding back everything and deducting everything, you can adjust the net figure also. Both are right, no problem for that. All right, but I am preferring for the complete adding back and deducting. It's up to you which method you want to follow. All right. So friends, moving forward with the next adjustment. What is the next adjustment? It says that Mr. Anish, okay, there is one more depreciation is there. All right, don't worry, we will compute it separately. Okay. So Mr. Anish purchased the car on 2/4/2020 for 3,35,000 for his personal use. So he purchased the car for his personal use. However, on 30th April 2021, that means in the next year, he bought the car for use in his profession. The fair market value as on that particular date was 2,50,000. So it is just like this year I'm purchasing a car, I'm using it for my personal purpose. And the next year I'm introducing this car into my profession. All right, I have started using it for my professional purpose. Then how to compute depreciation for that? So let's compute a depreciation for the car also. So we will deduct depreciation for the car. Again, working note number 2. We will write a separate working note for that. All right. So here is working note number 2. Depreciation on car. All right, friends. So listen. It says that he purchased the car. The purchase was made in which year? 2/4/20. That means in the year 2021 he has purchased the car. For how much value? For 3,35,000 rupees. And they are also stating in which year they have bought into business. On 3/34/2021 they have introduced the car into business. So how to take the actual cost? There is no speciality, friends. Say in the first year I'm purchasing and the next year I'm putting that particular car for my business purpose, then you can take the entire purchase cost as the actual cost of that particular car. And you can claim depreciation on this entire 3,35,000. But friends, listen, if it was building instead of car, if it is building, say for example, this year I'm purchasing a building and I'm using it for my personal purpose. And the next year I'm introducing that particular building for my business or professional purpose. In that case, I must deduct notional depreciation of that particular building as well. There is a clause in income tax for that. This is only applicable for buildings, not for the other assets. For car and all, even if you are introducing this car for your professional or business purpose in subsequent years, you can take the actual purchase price as the actual cost for computing depreciation. I hope that point is clear for you. All right. So what you can take is 3,35,000 you can take as a actual cost. And what is the rate of depreciation for car? And currently the rate of depreciation for car is 15%. But if you are using this car for renting, hiring, etc., then you can take 30% as the rate of depreciation. But currently the rate of depreciation for a normal professional for using his car for his professional purpose is 15%. So 3,35,000 into 15%, what will be the depreciation? It is 50,000. 250 will be the amount of depreciation that we can claim for the car. So we can compute that 50,250 as well. 50,250 is the rate of depreciation for car. So it is 50,250. So actually the depreciation amount will be somewhere around 1,02,000 something, right? But we have computed it separately, no problem for that. Or you can do, you can add this 50,900, 51,900 and 50,250 together, and you can treat it as a depreciation, a single figure also. That's also possible, no problem. But I have considered it separately. All right. So listen, it's not yet over. Let's discuss the other remaining things in this particular question also, friends. So what are the other further adjustments in this question? Mr. Anish has made a contribution of 1 lakh in public provident fund account. Super. So a person, if he's a professional or self-employed or whatever, he contributes something to the public provident fund, then he can claim that contribution as a deduction under 80C. Hope you remember. So contribution to public provident fund is definitely allowable as a deduction under 80C. So we will write 80C deduction, that is contribution to PPF. How much is the amount? It is 1 lakh rupees. All right, that is allowable as deduction. And in the question, they are not stating that it has been deducted in the income and expenditure account. So they haven't considered that amount in the income and expenditure account. That is our assumption. And again, the gross professional receipts of Mr. Anish for the previous year 21-22 was 52 lakh. It does not have any other relevance in this question. We have already used that particular information for computing the TDS factor. All right. Now, compute the total income and tax liability of Mr. Anish for assessment year 22-23, assuming that he is not opting for the 115 BAC. All right. Now, one more important thing is there. Before finishing this question, you need to go to the income and expenditure account and have to go through each and every item covered under income and expenditure account. So the first item, employee remuneration and benefits, no problem. Office administrative expenses, no problem. General expenses, no problem. Electricity expenses, no problem. Medical expenses, we have already adjusted. Then purchase of furniture, we have already considered. Depreciation, we have already considered. Income, excess of income over expenditure, that means the profit, we have already considered. Consultancy charges is definitely, that is your professional income. Interest on public provident fund. First of all, let me ask you one single question. Is this interest on public provident fund an income under PGBP? The answer is no. Interest on public provident fund is basically not an income under PGBP. Then what is the tax effect of this 60,000? Interest on public provident fund is fully exempted. Hope you remember. Under the head salaries, there is an exemption for the public provident fund interest. So the interest on public provident fund and interest on recognized provident fund, both are fully exempted. All right, subjected to certain limits and conditions. So here we can claim this entire 60,000 as an exemption under while computing taxes according to the Income Tax Act. So what we can do, we need to deduct this interest on public provident fund. How much is the amount? 60,000. So interest on PPF is fully exempted. All right. And friends, there was one more point which I must tell you in relation to this exemption, that is, with effect from 1st April 2021 onwards, if aggregate contribution to the public provident fund exceeding 5 lakh rupees, then interest accrued on excess contribution will be fully taxable. You will not get the exemption which is mentioned under section 10 subsection 11. So hope you remember that was a new amendment which is a part of your February 2021 annual budget. It says that normally this interest and other sum under public provident fund is exempted under section 10 subsection 11. But they are saying if the aggregate contribution to the public provident fund by the contributor exceeds rupees 5 lakh, then interest on excess contribution will be taxable. Say for example, you are contributing 7 lakhs to the PPF every year. Then 2 lakhs is the excess contribution over and above 5 lakh. Interest on this 2 lakh will be fully taxable without any exemption. The other interest is fully exempted under section 10 subsection 11. Hope you remember this new amendment which came as a part of your February 2021 annual budget, which is applicable for your May 22 and November 22 attempt. All right. So this was just a reminder for you. All right. And friends, here the contribution is only 1 lakh, right? So we don't need to think about this particular taxes. The full interest would be what? Exempted in the hands of assessee. All right. So let's move on with the other adjustments. Interest on savings bank account. So first of all, interest on savings bank account is not taxable as a business profits. It is taxable under income from other source. So we need to adjust that in our computation as well. So friends, let's go to the computation and we need to deduct interest on savings bank deposit. How much is the interest on savings bank deposit in the question? So the question says interest on savings bank is 20,000 rupees. We need to deduct it from here. Then we need to consider it as an income from IFOS, other sources, that is interest on savings bank. And how much is the interest, friends? It is 20,000. And friends, one more thing you can get, you are eligible to claim it as a deduction under section 80 TTA. If the assessee is not a senior citizen and a resident, then if he has some savings bank interest income, then he is eligible to claim that interest as a deduction under section 80 TTA of income tax. But the only thing is the maximum deduction under 80 TTA would be 10,000 rupees. So the maximum deduction that he can claim would be what? 10,000 rupees. I hope that is also clear for you. Now, moving on with the next adjustment, that is interest on National Saving Certificate 8 for the third year. It is 21,000. So friends, first of all, this interest on National Saving Certificate is not taxable under PGBP. It is fully taxable under IFOS. So we need to adjust this particular thing from PGBP. So less interest on National Saving Certificate 8. And the interest income in this particular question, how much is the interest income in the question, friends? The interest income in the question is 21,000. We need to deduct it from the taxable business profits. Then you can add it as an income under IFOS. So interest on National Saving Certificate 8, 21,000 will be an income taxable under IFOS. But friends, this National Savings Certificate scheme, it's actually a 5-year scheme. 5-year scheme means, see, year 1, say for example, year 1, if you contribute something to the National Savings Scheme, year 1 you will get interest. This interest will be automatically what will get credited in this particular NSE. And the next year, on this 1 lakh and the interest of first year will be your total contribution in NSE account. And the second year, you will get interest on the entire fund balance. It is like that. So till 5th year, every interest income will automatically what will get deposited or will get reinvested to the National Savings Certificate Scheme 8. This is how it works really, or in practice, this is how it works. So friends, the question itself says this is the third year. This is the third year and the interest income accrued on the fund balance in the third year is 21,000. Yes or no? And this 21,000 without any other further information, we can, it is not an assumption, it is very obvious. This 21,000 will automatically get reinvested to the National Saving Certificate 8. This is how it works. So there is actually a lock-in period for 5 years. So in the third year, if you are receiving interest, it will automatically get reinvested to the National Saving Certificate 8. And again, like this, in the fourth year, if you are receiving any interest, again it will be automatically get reinvested to this particular National Saving Certificate 8. This is how it works. Alright, so tell me, when this 21,000 is getting automatically reinvested to the National Saving Certificate 8, it is just like you are contributing this 21,000 to the National Saving Certificate, yes or no? If you are contributing something to the National Saving Certificate, then what happens? You are eligible to claim that contribution as a deduction under Chapter 6A 80C. Hope you remember, under Chapter 6A deductions, if you are contributing something to the National Savings Scheme 8, that equivalent contribution is eligible as a deduction under 80C. And hence what we can do, we can claim that entire 21,000 as a deduction from 80C always, or on 80C as well. So contribution by way of reinvestment, the amount is 21,000 that you can claim as a deduction under Chapter 6A 80C item. All right. So I think there is no further adjustment is there. We have considered each and every adjustment. Now let's compute. First, let's compute the business profits. We will compute the business profits and we will move forward. So the first thing that you need to know the profits from business. So let's compute the profits from business first, friends. So how much is the profits from business? Let's compute it together. It says 39 lakh 43,000 plus 20,000 plus 10,000 plus 80,000 plus 7,500 minus 51,900 plus 90,000 plus 48,000 minus 50,250, then minus 60,000 minus 20,000 minus 21,000. It would be somewhere around 39,95,350 rupees will be the business profits, right? So 39,95,350 rupees will be your business profits. Now what is the income from IFOS? Oh, you don't need a calculator for computing that, right? So what is the income from IFOS? So the income from IFOS is 41,000 rupees. So 41,000 rupees will be the income from IFOS. All right. Now IFOS, it will be 41. Now what is the gross total income, friends? Gross total income would be 41 plus 39 lakh amount, that is around 40 lakh 36,350 rupees will be your gross total income, because it's 41,000 plus 39 lakh 95,350. All right, it will be 40 lakh 36,350. Now there are Chapter 6A deductions, so we will take Chapter 6A deduction over there. All right, so we will take it over there because we have enough space. Yeah, so we are taking Chapter 6A deductions to here. And how much is the deduction, friends? It is 50,000 plus 1 lakh plus 21,000 plus 10,000. So after deducting all these items, the chapter, that means after deducting this Chapter 6A deduction, that will be around 1,61,000. We can take the total income would be, the total income after deducting this Chapter 6A deduction would be, total income would be 38 lakh 55,350 rupees. 38,55,350 will be the total income. Super. Now friends, it's not over. They are also asking us to compute what? The tax liability also. So let's compute the tax liability. So computation of tax liability. So how to compute the tax liability, friends? Over and above and above 10 lakhs will be subjected to 30% rate. So over and above 10 lakhs would be 28 lakh 55,350 into 30% plus from 5 lakh to 10 lakh, that 5 lakhs will be subjected to 20% rate. That would be 1 lakh. Then for the first 2 lakh 50,000, from 2 lakh 50,000 to 5 lakh, that 2 lakh 50,000 will be subjected to 5% rate. That would be 12,500. So we'll take 28 lakh 55,350 into 30%. It would be 8 lakh 56,605. Here it would be 1 lakh. And here it will be 12,500, and the basic tax liability in total would be 1 lakh plus 12,500. It will give you 9,69,105. 9,69,105 will be your basic tax liability total. Basic tax liability total. And there is no requirement of surcharge. Yeah, there is no requirement of surcharge because the total income is only 38,55,350 rupees. So the surcharge limits will be applicable from 50 lakh onwards. From 50 lakhs, individual is supposed to pay surcharge at 10%. If the total income is over and above 1 crore, then 15%. If the total income is above 2 crore, 25%. And if the total income is above 5 crore, 37% will be the surcharge. Here the total income is only 38 lakhs, so no surcharge liability is there. So health and education cess at 4% also will come. So 969 into 4% it would be 38 lakh 764 rupees. Not 38 lakh, it is 38,764 rupees. So by adding that, our total income, total tax liability would be 10 lakh 7,869 rupees and we can round it off to 10 lakh 7,870 rupees, and that will be the total tax liability of this particular question. I hope this is clear. And friends, this has been solved after considering all the amendments as well. So this is the final answer of this particular question. So if you are able to write this much, you can score how much marks? 14 marks. This is a hardcore past exam question and I hope it is clear for you. Alright friends, so let's move on to question number 2. So let's go through question number 2 and let's solve the answer. This question is asked for 6 marks in your July 21 examination. Alright, so let's read together question number 2. So question number 2 says Mrs. Rohini, aged 62 years, that means a senior citizen, was born and brought up in New Delhi and got married in Russia in 1996. And settled there since then. So from 1996 onwards, she is in Russia. And since her marriage, she visits India for 60 days each year during her summer break. The following are the details of her income for the previous year ended 31st March 2022. So her income details is also given in the question. So she has some pension receipt from Russian government, long-term capital gain on sale of land at New Delhi. Then she has short-term capital gain on sale of shares is there. Then some premium paid to Russian Life Insurance Corporation at Russia is there. Then rent received equivalent to the annual value in respect to house property in New Delhi is given. You are required to ascertain the residential status of Mrs. Rohini and compute her total income and tax liability for assessment year 22-23. So you are required to compute 3 things. First, the residential status of Ms. Rohini. Second, her total income, and third, her tax liability. So we'll start with the residential status first. Residential status first. So as you know, under section 6, determination of residential status of an individual is very much simple. There are 2 ways for determining residential status of an individual. Either that individual should stay in India for 182 days or more, or that individual should stay in India for 60 days or more in the relevant previous year plus 365 days or more in 4 preceding previous years. So if you are not sure about the residential status, then I have done a separate video in my YouTube channel. You can check for the determination of residential status of individual. Alright. So listen. So this 60 plus 365 days condition, these are 2 alternative conditions. Either an individual have to be have to be in India for 182 days during a relevant previous year, or that individual should be in India for 60 days or more in the relevant previous year. Along with that, in total 365 days or more in 4 preceding previous years. These are the criteria. And the 60 plus 365 days condition, the second criteria is not applicable for an Indian citizen or Indian origin who's residing outside India. Residing outside India, comes on a visit to India. Comes on a visit to India. So if you are an Indian citizen or an Indian origin and you are currently residing in some other country and you are visiting India occasionally, say for example some special purposes, say for example for Christmas or for Easter or for Vishu, Deepavali, for Ramzan, etc. If that particular person is visiting India for different special occasions and she or he is going back after this thing, then normally the 60 plus 365 days condition is not applicable for those people who are Indian citizen or Indian origin who is residing outside India and comes on a visit to India. And for those people, determination of residential status will be based on these days of stay, that is 182 days or more in India. And as a part of February 2020 annual budget, there has been a new amendment also. It states that if that particular individual has income from Indian sources, which is more than 15 lakhs, then for determining residential status, his days of stay in India should be 120 days or more in the relevant previous year plus 365 days or more in 4 preceding previous years. So if that if that particular Indian citizen or Indian origin who is residing outside India has income from Indian sources which is more than 15 lakh, then he can be treated as a resident by, there is one additional condition also for that, either based on his days of stay in India, that is 182 days or more, or there is an alternative condition they are saying, that is his days of stay in India should be for 120 days or more, plus his days of stay in the 4 preceding previous year in aggregate should be 365 days or more. So these are the criteria for determining residential status of an individual currently. Alright, now let's apply these things into our question. So Rohini's age is 62. She was basically born and brought up in New Delhi. So anyway, she is an Indian origin. She is a pure Indian origin. Maybe an Indian citizen as well. We don't know what exactly is her citizenship, but she is anyways an Indian origin. Her parents or grandparents, if they are Indians, then that person is normally called as what? Indian origin. And she got married in Russia in 1996 and settled there since. So since her marriage, she visits India for 60 days every year during her summer break. The following are the details for the previous year ended 31st March 2022. So in the previous year, 2021-22 also, she will be visiting India for 60 days. Yes or no? And as you know, if Rohini is an Indian citizen, then what? His residential status will be determined on the basis of either 182 days or more condition. Or if she has income from Indian sources which is more than 15 lakh, then her residential status will be determined on the basis of what? 120 plus 365 days condition. Since her visit in India for every year is only 60 days, she will be anyways what? A non-resident. Why? Because the 60 plus 365 days condition is not applicable for an Indian origin or an Indian citizen who is residing outside India, comes on a visit to India. I hope that is clear for you. Alright. So her residential status in the year 21-22 would be what? Non-resident. So we have answered the first part, that is her residential status is non-resident. Now friends, it's time for us to compute her total income. So computation of total income of Mrs. Rohini. Mrs. Rohini, who is a non-resident. She is a pure non-resident in the year 21-22. So based on that, we need to compute the total income of Rohini. Alright, so we will take different adjustments from the question and we will compute it together. So the first one is pension receipt from Russian government. So I hope you remember, for a non-resident, for taxing her income in India, there can be two possibilities. That is, based on source rule, there can be two possibilities. And hope you remember the source rule. What is source rule? For determining the taxable income of a non-resident, her income should have source in India. What do you mean by source in India? It means either accrued in India or first received in India. Or first received in India. That income should be either accrued in India or first received in India. Alright, if an income is accrued in India or first received in India, then definitely that particular income will be taxable in India. Otherwise, all other incomes which is not received in India or not sourced in India or not accrued in India, we cannot tax it in India. Say for example, a German citizen is receiving some income in Germany. Can India tax that particular income from Germany? Not possible. We cannot. That's what I've said. For a non-resident, her taxation is based on the source rule. And what is source? That accrual, the right to receive the income, either it should be from India or the first receipt of that particular income should be from India. Alright, then only we can tax that particular income. Now let's go back and read the first adjustment. Pension receipt from Russian government. You tell me whether it is taxable in India or not. It is purely not taxable. So pension from Russia, not taxable. NT means what? Not taxable. That is the first thing that you should know. Now moving on to the second item, that is long-term capital gain on sale of land at New Delhi. So friends, under section 9, that is income deemed to be accrued or arised in India, it is very clear that if a non-resident is earning some income on account of a capital asset which is situated in India, then all the gains from that transfer shall be deemed to be accrued or arised in India. So if a non-resident is receiving any gains on account of transfer of a capital asset which is situated in India, then all that gains would be deemed to be accrued or arised in India, and hence this 3 lakh will be deemed to be accrued or arised in India according to section 9, and it will be taxable in India as well. So under section 9, or first we will write the item name. So what is the item? It is long-term capital gain on sale of land. All right. So long-term capital gain on sale of land. Where is that land? It is in New Delhi, right? So it is in New Delhi. It is computed. It is 3 lakh. So as a note, we can say under section 9, income from transfer of capital assets situated in India shall be deemed to be accrued or arised in India. Shall be deemed to be accrued or arised in India. All right. Now that's the point, and yeah, it is a long-term capital gain. So the taxability will be under section 112. Hope you remember. The long-term capital gain normally taxable under 112 at what rate? At 20% rate of tax. All right. Now moving on to the third item, we will compute the taxability later. Moving on to the third item, it is again short-term capital gain on sale of shares of an Indian listed company in respect of STT was paid both at the time of acquisition as well as the time of transfer. First of all, short-term capital gain of shares of an Indian listed company. So she is transferring an Indian company shares and she receives some capital gains, then definitely that capital gains will be taxable in India. That is the first thing that you should know. So that particular short-term capital gain on transfer of listed shares will be definitely taxable in India. And what is the amount, friends? The amount in the question is 60,000 rupees. All right. So here also we can write under section 9, transfer of Indian company shares. Indian company shares is deemed to be accrued or rise in India. Deemed to be accrue or arise in India. That means income from transfer of shares. Income from transfer of shares. Income from transfer of Indian shares shall be deemed to be accrued or rise in India according to section 9. It is as simple as that. Now friends, this as you know will be taxable under 111A of income tax. And what is the rate? The rate will be 15%. So you should know the tax rate also for these two items. For 112 it is 20% and 111A. Hope you remember what is 111A? If you have short-term capital gain on transfer of listed shares or listed unit of equity oriented funds or listed units of business trust, then that particular gain will be taxable under 111A at the rate of 15%. Hope you remember these things. All right. Now, moving on to the fourth item is premium paid to Russian Life Insurance Corporation, 75,000 rupees. Now the question you will ask me that, so whether assessee can claim this premium paid to Russian Life Insurance Corporation? The answer is yes. Under 80C, it only says life insurance premium paid. Under 80C, the Income Tax Act is not saying that the life insurance policy have to be taken in India. Are you all listening, friends? Listen. The point is very simple. Say, for example, I am a German citizen. All right. Say I am a German citizen. And I have some taxable income in India. I have some taxable income in India. While computing the taxable income in India, I can claim all the Chapter 6A deductions also in India. If I have taxable income in India, then I can definitely claim all the Chapter 6A deductions as well in India. All right. Likewise, here Rohini is basically a Indian origin and she has some taxable income in India and she paid some life insurance premium which is actually in Russia. She had taken some life insurance from Russian Life Insurance Corporation and she is paying some premium for that also. That premium is definitely deductible under 80C, under Chapter 6A, no doubt for that. Are you guys with me? So definitely this 80C deductible item, it is an 80C deductible item. So under section 80C, premium paid for Russian life insurance is definitely deductible. And how much is the sum, friends? So as per this question, the sum is 75,000. So for the time being, we can write this 75,000 here. Right? Now listen. Again, there is one more item. Rent received equivalent to annual value in respect of house property in Delhi is 90,000. So she has received some rent where the property is in India. If the property is in India, then definitely the income is actually accrued in India. Yes or no? She is a non-resident, but she has some property in India and she is receiving some rent from the property which is situated in India. Then that rent will be definitely taxable in India because the accrual is in India. Yes or no? So this 90,000 will be definitely taxable in India. So we can write it as the fourth item here. So rent from property in India. How much is the amount? It is 90,000 is the amount. And this is the annual value. All right. So the question clearly says that this is the annual value 90,000. From the annual value, normally we can deduct the municipal taxes paid. But in this question, we are not sure whether he have paid municipal taxes or not. And we are not sure whether there is municipal taxes in Russia. We don't know. All right. So we don't deduct the municipal taxes anyways. So, but we can deduct what standard deduction. We can deduct standard deduction at 30%. So tell me, friends, what is 30% on 90 lakh? It will be 27 lakh. Sorry, not 90 lakh, 90,000. It will be 27,000 will be the standard deduction. Yes or no? So after deducting this 27,000, what will be the taxable income? It will be 63,000 rupees. Now, what are the other adjustments? There are no other adjustments. So let's compute the total income. So first of all, let's compute the gross total income, friends. So tell me, what is the gross total income? Gross total income. Let's compute. So the gross total income would be 3 lakh plus 60,000 plus 63,000. So 3 lakh plus 60,000 plus 63,000, it would be 4 lakh 23,000, right? So the gross total income will be 4 lakh 23,000. Now to the chapter 6a deduction, friends. Before deducting chapter 6a deduction, hope you remember, if you have taxable income under section 112, that is long term capital gain, or you have taxable income under section 111A, that is short term capital gain on transfer of listed equity shares or listed unit of equity oriented fund or listed unit of business trust. From this long term and short term capital gain, no assessee is supposed to claim what? Chapter 6a deduction. Hope you remember, there is a thing like this. Will be covered under capital gains chapter. Is actually covered under capital gains chapter. So if you are an assessee having total income under 112 or 112A or 111A, from these three capital gains, no assessee is supposed to claim chapter 6a deduction. Now friends, what is the actual ATC item here? 75,000 rupees. But out of his 4,23,000, 3 lakh is on account of long-term capital gain and 60,000 is on account of short-term capital gain under 111A. So ultimately, he can claim chapter 6A deduction only from the 63,000, which is income from house property. Yes or no? Yes or no? So ultimately, even though he is allowable 75,000 rupees, or even though ATC allowable expense is 75,000, you cannot claim that much amount from the total income, because the total income consists of what? Long-term capital gain and short-term capital gain. So the only item which is deductible is 63,000. So we can say this ATC deduction shall be restricted to 63,000. We can say ATC deduction shall be restricted to 63,000 rupees. Why? What is the reason for this? Why? Because from long-term capital gain and short-term capital gain, no assessee is supposed to claim what? Chapter 6a deduction. I hope that adjustment is clear for you. All right. So you have to be very careful here. All right. Now, friends, you tell me what is the total income after this deduction. So the total income would be, as we all know, 3,60,000. So no, 3,60,000 would be the total income. Now let's compute the tax liability. So friends, before computing tax liability, hope you remember, while computing long-term capital gain under section 112 and short-term capital gain under section 111A, assessee can claim unexhausted basic exemption limit. Basic exemption limit only if the assessee is an individual or a Hindu undivided family and the assessee should be a resident in India. Only for resident individuals and HUF they can claim unexhausted basic exemption limit from their long-term capital gain and short-term capital gain. Since Mrs. Rohini is not a resident in India for the year 21-22, she cannot take the benefit of claiming unexhausted basic exemption limit from the LTCG and STCG. Alright, so we have to compute taxes. Under section 112, for 3 lakh total income, the rate of tax is at 20%. And under section 111A, for that 60,000 rupees will be taxable at 15%. Alright, so what will be the basic rate of tax? 3 lakh into 20% would be 60,000 rupees, and 60,000 into 15% it would be 9,000 rupees, and total it would be 69,000 rupees is the basic tax liability. Cess at 4% also would come. So 69,000 into 4% cess, it would be 2760. So after adding that with the profit, it will be 71,760 will be your final tax liability. I hope this is also clear for you. All right. So while solving this question, you have to be very careful, friends. And what is the mark weightage for this question? It carries 6 marks. I hope it is super clear for you. All right, friends. So let's continue with question number 3 right now. So let's read question number 3 and let's solve the answer together. So it says that examine whether TDS provisions would be attracted in the following cases, and if so, under which section, and also specify the rate of TDS and the amount required to be deducted at source as applicable in each case. Assume that all payments are made to residents. So in the following situations, you can assume that all the pays are what? Residents. All right. So let's start solving this particular question. So what all are the question requirement, friends? We will read the question again and let's check the requirements again. First, you need to say whether TDS provisions are attracted. All right. So we need to say whether TDS applicable or not. That is the first thing. Then we need to comment on what? If applicable. If applicable, the section number also you have to specify. All right. Then, and the rate of TDS, and also the amount of TDS. These are the things that you must specify in the following scenarios. All right, super. So let's read with the situation A. So Mr. Kale, receiving pension income from central government, has paid contractual payment made during the April 2001 for reconstruction of his house in Arunachal Pradesh, and the aggregate amount of payment he have made in the year 21-22 is 52,50,000. So this is paid by Mr. Kale, right? So we will call him Mr. K, and he is a pensioner. He is in receipt of some pension. So he's not carrying out any business or profession. All right. And he is making some contractual payment. Contractual payment. That's what they are saying. So he makes some contractual payment and the amount he pays in the year in total is 52,50,000. That's what they are saying. So this payment is made for some construction of his residential house also. Now friends, contract payments are normally covered under 194C. All right. But under 194C, if the person who makes the payment, so what is basically this TDS? One person while paying payment to some other person, the person who makes the payment is supposed to deduct a percentage of tax as TDS, and he is supposed to pay it to the credit of central government. So here the deductor is Mr. K. And under 194C, it says that if the deductor is individual, HUF, AOP or BOI, then they will become deductors under 194C only if their business total turnover in the preceding financial year exceeds 1 crore or their professional gross receipts in the preceding financial year exceeds 50 lakh. These are the criteria under 194C for individuals, HUF and AOP or BOI to deduct TDS. All right. Now, this question, Mr. K is a pensioner, so his business turnover in the preceding financial year will be what? 0. The relevant previous year is 2021-22. So in the preceding financial year will be 2020-21 and his business turnover would be nil because he is a pensioner. He is not doing any business, and hence we can say 194C is not applicable here. Now, if 194C is not applicable, then there is an alternate section, that is 194M. Under 194M, if any individual, HUF, AOP or BOI is making any payment, is in nature of any contractual payment, and the same is not covered under 194C, then you have to check whether it is covered under 194M. And under section 194M, it says 194M will be applicable if the aggregate payment in the financial year exceeds 50 lakh. If the aggregate payment in the financial year exceeds 50 lakhs only, this 194M will get attracted. And here Mr. K makes an aggregate payment of 52,50,000. So 194M will definitely come into picture. All right. And what is the rate of tax under 194M? 194M says that the rate of tax is at 5%. The rate of tax is at 5%. percentage. And now the question, what is the time of deduction under 194M? That also we must comment on. The time of deduction is actually not asked in the question, right? They haven't asked about the time of deduction, but we can say from our own side the time of deduction will be at the time of credit or payment, whichever is earlier. All right. So the time of deduction, since it is not asked, I am not writing that. So the total payment made by the person is 52,50,000 into 5% will be the TDS amount. So 52,50,000 into 5%, it would be 2,62,500 rupees will be the TDS that have to be deducted by Mr. K. So let's comment on these things. TDS applicable or not? The answer is yes, TDS is definitely applicable. What is the section number? Is under 194M. Now what is the rate of tax? At 5%. Now what is the amount of TDS that required to be deducted? 2,62,500. So we have answered all the things which they have asked in the first thing. All right. Now that is the first scenario. Now friends, moving on to the second scenario. What is the second scenario? Case B. Mr. Rahul, a wholesale trader of spices whose turnover was 5 crore in the financial year 2021, again made a contractual payment for construction of office godown during January to March 2022 to Mr. Akhilesh, an individual, and the amount which he paid is 50 lakh in the year 21-22. All right, so let's check. So this will be covered under, this is also a contractual payment, and the payer is an individual, and his preceding financial year, that is in the year 2020-21, his business total turnover is given in the question. So what is the business total turnover in the question? It is 5 crore. All right, so it is 5 crore. So definitely what we can say, it is 5 crore and 194C will come into the picture. All right, and he makes a payment of 50 lakh rupees. He makes 50 lakh rupees. And this payment is in relation to what? Construction of office godown. So this payment is for business purpose. Business purpose as well. So we can say under section 194C, TDS have to be deducted at what percentage? Under 194C, if the payee is individual or Hindu undivided family, the rate of TDS would be 1%. And in the case of other payee, that means if the payee is a partnership firm, LLP, company, etc. Payee, I'm talking about not payer, payee. That means the person who is in receipt of that income. If that person is other assessees other than individual and HUF, then the rate of tax will be 2%. Here the payer is the Rahul and payee is Mr. Akhilesh. He is an individual. So the rate of tax would be 1%. All right. So on this 50 lakh, TDS have to be deducted at 1% and the sum would be 50,000 rupees. That is the answer for alternate B. Now let's answer to the specific questions which they have asked. Whether TDS is applicable or not in the second case, TDS is definitely applicable. Section number 194C. And what is the rate of tax? At 1% since the pay is an individual. Now what is the amount of TDS that have to be deducted? It is 50,000 rupees as well. So let's take it down. We will take it down. All right. So moving on to the next scenario. What is the next scenario, friends? So let's discuss the next scenario as well. So scenario C. It says Mr. Golu, an individual carrying garment trading business with a turnover of 95 lakh in the financial year 2021, is made a payment of commission to Mr. Vinay for securing a contract from a business house in November 2021. And the amount which he have paid is 1,20,000. So here the pair, who is the pair? It means Golu. Golu is the pair. All right, the person who made the payment is Golu. So the payment is in relation to commission. The payment is in relation to commission. Normally it is covered under 194H. But under 194H, it says that if the person who makes the payment is individual or Hindu undivided family, then he's supposed to deduct TDS under 194H only if his preceding financial year's business turnover exceeds 1 crore or professional gross receipts exceeds 50 lakhs. Hope you remember. Under TDS, we have learned this. Now friends, what is his business turnover in the preceding financial year? So in the question, it clearly states that his financial year 2021, his total turnover from trading business is only 95 lakh. So we can say 194H, that means TDS on commission, the rate at 5% will not be applicable here, not applicable here. And it is covered under 194M. Let's check whether it is covered under 194M. Again, it is also not applicable. Why? Because the payment for applying 194M, the aggregate payment in a financial year have to be more than 50 lakh rupees, because 194M states that if a person is not covered under, if an individual is not covered under 194J or 194C or 194H, and he should make a total payment of more than 50 lakhs. He should make an aggregate payment in the financial year which is more than 50 lakhs, then only 194M will come into the picture. So here 194M is also not applicable since the amount of payment is only 1,20,000 rupees. That is the total amount of payment that he makes. So what is the final answer? The final answer is very simple. TDS is not applicable. So let's specifically answer this question. TDS not applicable. Section number 194H and 194M we have referred. Rate of TDS, 194H it is 5%, 194M is also 5%. Amount not applicable. Alright, or we can say not applicable everywhere, because since it is not covered under any of the TDS, we can say section number not applicable, and we can also say rate not applicable also. But you have to write the reasons. So friends, what are the reasons? Both 194H and 194M is not covered. 194H, the payer, if he is an individual, his preceding financial year's business turnover have to be more than 1 crore, or preceding financial year gross receipts from his profession should be more than 50 lakhs. Here both the conditions are not satisfying. Alright, if he is a business person, if he is a professional, then his preceding financial year's gross receipt should, if it is more than 50 lakh, then 194H would have applicable. So here he is a businessman. So the thing which you have to check is his preceding financial year's business turnover. That should be more than 1 crore for 194H to come into picture. I hope it is clear. Right? Now friends, moving on to the next situation, that means the person who makes the payment is a XYZ Urban Cooperative Bank. Alright, so XYZ Urban Cooperative Bank is making a payment by way of cash withdrawal by ABC & Co, a partnership firm amounting to 1 crore 20 lakhs during the financial year 21-22, and ABC & Co has filed its returns for the last 3 financial year within time. So let's check. So here the relevant section would be 194N, that is cash withdrawals. Cash withdrawals exceeding 1 crore. So any person who withdraws cash from a scheduled bank or a cooperative bank and the amount of cash withdrawn is more than 1 crore, then whatever excess withdrawal over and above 1 crore will be subjected to TDS under 194N at the rate 5%. Sorry, at the rate 2%, not 5%, at the rate 2%. That's what the act says. Now listen. Under 194N, there is one more additional clause. If the person who is withdrawing in the year 21-22, if he haven't filed his return for the year 2021 or 19-20 or 18-19, if he haven't filed return for all of the 3 years, then TDS have to be deducted from what amount? TDS have to be deducted over and above 20 lakh withdrawal at the rate 2%, and over and above 1 crore withdrawal, TDS have to be deducted at 5%. But that scenario is not applicable here, because in the question itself, he is specifically stating that ABC & Co, the payee, that means the person who withdraws the amount, has filed its return for all the 3 years. If he's filed his return in any of the 3 years, then that 20 lakh exceeding withdrawals TDS is not applicable. But in the question, it's very clearly stated that he has filed his return for all of the years. So that particular provision you don't need to check. Alright. So here TDS will be applicable under 194N, and how much? over and above 1 crore, how much withdrawal he has? So he has withdrawn around 1 crore 20 lakhs, right? So over and above 1 crore is 20 lakhs into 2% will be the TDS that have to be deducted. And what will be 2% on 20 lakhs? Into 2%, it will be 40,000 rupees will be the amount of TDS that have to be deducted. So tell me friends, let's go to the specific question. TDS applicable? Yes, TDS applicable under 194N. And what is the rate? At 2%. And what is the amount? 40,000 is the amount. That's it. And I hope this question is super clear for you, because there is no confusion or no complexities involved in this question. It's only a very simple question. And what is the mark weightage for this question, friends? It carries 8 marks. It carries 8 marks. That means 2 into 4. For every adjustment, you will get 2 marks in exam. For every adjustment, you will get 2 marks for your exam, because TCS chapter is very, very, very important for your exam, because if you know what is the exact rate of TDS and the section numbers, you will get all of these 8 marks in a go. I hope it is clear for you. All right, friends. So moving on to question number 4, it states about Mr. Ramesh constructed a big house. Construction completed in the previous year 2008-2009 with 3 independent units. That is, unit 1, 50% of the floor area is let out for residential purpose at a monthly rent of 15,000. So we will draw a flow chart, or we will draw a picture while reading that question itself, so that it will be easy for us to solve the answer. All right. So this is the house. All right. And 50% floor area, 50% floor area of this house is let out for a monthly rent of 15,000 per month is the rent which he receives for the let out. All right. So that's what they are saying. Now, a sum of 3,000 could not be collected from the tenant, and a notice to vacate the unit was given to the tenant. So, a 3,000 rupees out of this rent, there was 3,000 which was not realized, and a notice has been sent to the tenant for realizing the 3,000 rupees. It is not 3,000 per month. Okay, it is 3,000 rupees is not realized. That's what they are saying. All right. Now, collected from the tenant, and a notice to vacate this unit was given to the tenant. No other property of Ramesh is occupied by the tenant. That means that there are certain conditions for calling particular rent as unrealized rent. Number 1, it should not be capable of being realized, right? So number 1, the tenancy should be bona fide. Number 2, the steps have been initiated to making him vacating from that particular property. Number 3, he should not be occupied in any other properties of the assessee. And number 4, legal proceedings have to be initiated against that particular tenant. So here we can say 3,000 was not collected, and a notice to vacate the unit was given, and no other property of Mr. Ramesh is occupied by the tenant. So we can definitely call the 3,000 as what? A pure unrealized rent. I hope that is clear for you. Now, unit 1 remains vacant for 2 months when it is not put to any use. So there was a vacancy as well. So 3,000 rent was not realized. Along with that, there is a 2 months vacancy. 2 months vacancy is also there. All right. So it is also there in that particular let out property. Super. Now, unit 2, 25% of the floor area is used by Mr. Ramesh for the purpose of his business. So this is unit 1. We will call this as unit 1, and this may be unit 2, and it has been used as a self-occupied property, which was 25% of the floor area. All right, this was 25% of the floor area, and unit 3 remaining 25% is utilized for the purpose of his residence. So unit 3, or you can say this is unit 3, right? And this is unit 2, which has been used for his business purpose. Business purpose. And it is also 25% of the floor area. All right. Super. So yes, The other particulars of the house are as follows. There are certain other particulars as well. All right, now moving on with the next thing is municipal valuation of that entire house property is 1,88,000 and fair rent of the entire property is given 2,48,000 and standard rent of the entire property is given, that is 2,28,000. Municipal tax for the entire property is given. Then repairs for the property is given. Interest on borrowed capital for the construction of the property was 60,000. Then there was a ground rent. Maybe that ground where the property holds, maybe not owned by that. See, so there was a ground rent also in the question. And fire and insurance premium is 60,000. Then income of Ramesh from business is given 1,40,000 without debiting house rent and other incidental expenditure. Determine the taxable income of Ramesh for the assessment year 22-23 if he is not opting to be taxed under 115 BAC. This carries 6 marks. So this is only a very easy question, friends. So this carries around 6 marks in the July 2021 examination. All right. So let's start solving it. So this is, even though it is a single property, there are actually 3 portions of this property. We can say unit 1, which contains 50% of the floor area and which was let out. And unit 2 was 25% of the floor area and which was for use for the business. And unit 3, it carries 25% of the remaining floor area and it has self-occupied. All right. So what we need to do, we will compute in different manner. That is, we will compute let out property, then self-occupied property, we'll say business property, and then we will write self-occupied property. So we will split it into 3. All right. So let out property, let's compute the let out properties effect first. All right. Or we will do one thing, friends. We will compute the let out property and self-occupied property first. Then we will separately compute the business purpose property. All right. So self-occupied property. So let's compute the let out property. First, let's compute the net annual value of the let out property. All right. So how to compute the net annual value of the let out property? First, let us compute the expected rent of the entire property. So expected rent, first you need to compare the fair rent and compare it with the municipal value, and whichever is higher should be selected. That is the first step. So fair rent is there in the question and municipal value is also there. So whichever is higher means, which is the higher figure, friends? So the higher figure is obviously 2,48,000. So 2,48,000 will be the outcome of the first step. Then you need to compare this 2,48,000 with the standard rent, and whichever is lower shall be selected. And the standard rent is 2,28,000 and you compare 248 and 228 and whichever is lower, that simply means 2,28,000 is the lower figure and we can call it as the expected rent of the property. And friends, listen, this is the expected rent of the entire property. All right. Now let's compute the expected rent of the let out property. So out of the entire property, 50% of the floor area was let out. 50% of the floor area was let out. So let's compute the expected rent of let out property. Expected rent of let out property. Total expected rent is 2,28,000. 50% of the floor area was actually let out. So 228 into 50%, it would be what? 1,14,000 will be the expected rent of let out property. Now let's compute the actual rent of let out property. Actual rent of let out property. It was vacant for 2 months. That simply means 15,000 per month was the rent per month into 10 months minus 3,000. 3,000 was there, which is called as unrealized rent. All right. So 15,000 into 10 will be 1,50,000 minus 3,000. It would be 1,47,000 rupees will be the actual rent collected from that particular property. Now, friends, you tell me, we need to compare the expected rent and actual rent, and whichever is higher shall be the gross annual value of a particular property. And again, in the act it says, if on account of vacancy, if the actual rent is less, then you should consider the actual rent. But here the actual rent is high. So the actual rent will be the gross annual value of the property. So the gross annual value of the house property is 1,47,000 rupees. All right. Now let's deduct municipal taxes paid from this. Municipal taxes paid from this. So the total municipal tax of this house property is what? It is 20,000 rupees. So out of 20,000, 50% was for the let out portion, right? So 20,000 into 50% was there for the let out portion. That means 10,000 is the municipal tax which we can deduct. So after deducting municipal tax, the net annual value of the property would be 1,37,000 rupees. From the 1,37,000 rupees, as they can claim, standard deduction at 30%. So 1,37,000, 137 into 30%, it would be 41,100. 41,100 is the standard deduction, and there is some interest on capital as well. So interest on capital, or rather we can say interest on loan. Interest on loan taken for the construction of the property. How much is the total interest? So interest on capital borrowed for the construction of the property was 60,000 rupees. So the total interest was 60,000. So 60,000 is the total interest and 50% is the let out area, and hence we can take 30,000 as a deduction from here. Now let me ask you one simple question, friends. In the let out area, in relation to this property, there is a ground rent, fire insurance premium, etc. is there, repair is there. Can you deduct this repair, fire insurance premium, ground rent, etc. from the house property let out income? The answer is no. Irrespective of actual expenditure, an assessee can claim maximum 30% as the standard deduction if the property is let out property. Hope you remember, which we have discussed in the house property income chapter. So you cannot claim any other expenses. So here is the income from let out property. Income from house property, we can say, what is the income from let out property? So 1,37,000 minus 41,100 minus 30,000, it would be 65,900 will be the income from let out portion. All right. Now let's compute the income from self-occupied portion. The net annual value of self-occupied property will be always what? Nil. The net annual value of self-occupied property will be always nil. You cannot claim any municipal taxes paid, etc. as a deduction on account of a self-occupied property. So you cannot claim standard deduction also, but the only one deduction that you can claim on self-occupied property is the actual interest paid. So interest on loan, you can take it as a deduction. So the total interest is 60,000 rupees into 25% is the floor area of self-occupied property, right? So 60,000 into 25% is the floor area, that will be 15,000 rupees. So it will end up in loss from self-occupied property, that is loss from self-occupied property, it is 15,000. All right. So after netting off both of this, what is the net income? Net income from house property would be 65,900 minus 15,000, and that would be 50,900. 50,900 is the net income from house property. I hope this much is clear for you. Now it's not yet over. There is a portion of property which is used for the business purpose. So let's compute profits or gains from business or profession. So PGBP, what is the net profit in this question? So the net profit in this question is given, it is around 1,40,000. This is without debiting house rent and other incidental expenditure in relation to house property. So we will start from that. So 1,40,000 is the income from business. From that, you can definitely claim municipal taxes under section 30. Hope you remember, under section 30, if you have used a particular house property for your business purpose and you have paid rates and taxes on that particular property, you can claim that as a deduction. Hope you remember. So under section 30, the total municipal tax paid would be 20,000 into 25% is the percentage of use of the house property for business. So 20,000 into 25%, it would be 5,000 rupees you can claim as a deduction under section 30. All right. Now, what are the other expenses we have done with the municipal taxes? Then there is repair. So under section 30 again under section 30, they can claim current repair. Current repair. Being the repair amount is only, how much is the total repair amount? It is only 5,000 rupees. So we are assuming that it is current repair. So normally when we say repair, that means current repair only. So current repair is 5,000 is the total into 25% is the percentage used for the business purpose. So 5,000 into 25% is this 1,250 rupees. All right. Now, what are the other expenses? Interest on borrowed capital 60,000. So interest on borrowed capital, so we can deduct that under section 36. Interest on borrowed capital, the total interest is 60,000 into 25% is the percentage used for the business portion. So 60,000 into 25%, it would be 15,000 we can deduct from PGBP, then PGBP income. Then what is the next item? There is a ground rent of total 60,000. The ground rent is total 60,000. From the total 60,000 ground rent, not 60,000, 6,000 ground rent, you can what? The proportionate expenditure for business. Definitely you can claim it as a deduction under section 37. So less under section 37, ground rent. It is 6,000 in total into 25% is the proportion used for business. So 6,000 into 25%, it would be 1,500 rupees. You can claim it as a deduction. Then friends, what are the other things? Then there is a fire insurance premium 60,000. That is also deductible under section 30. So under section 30, fire insurance premium. What is the total fire insurance premium, friends? In the question, the total fire insurance premium is 60,000 rupees. So 60,000 into 25%, again the sum would be, it is 15,000 rupees. All right. Now, what are the other things in relation to this? There is no other item covered under this. So let's compute the net profit from business. So let's compute the net profit from business. What is the net profit from business, friends? So 1,40,000 minus 5,000 minus 1,250 minus 15,000 minus 1,500, then minus 15,000, it would be 1,02,250 rupees is the total income from business. 1,02,250. Now friends, let's compute the total income of this assessee. So total income of this assessee as per normal provision will be 1,02,250 plus net income from house property is 50,900. So 50,900 plus this figure, it would be 1,53,150 rupees is the total income taxable in the hands of Mr. Ramesh. I hope this question is super clear for you. Friends, before closing this question, let me tell you one thing. When you are computing income from house property, from a let out house property, actual expenses cannot be deducted. Irrespective of actual expenses, you can claim only standard deduction at 30% of the net annual value. Hope you remember. But if a portion of house property is used for your business, then that proportion of expense you can claim as a deduction from 30 to 37. So that's why we have claimed the proportionate business cost as a deduction from the net profit of business. I hope this much is clear for you. Alright friends, so let's move on to the next question, that is question number 5. Let's read question number 5 and solve it together. Examine the taxability of capital gains in the following scenarios for assessment year 22-23. Determine the taxable amount and the rate of tax applicable. So you need to compute the capital gain and the rate of tax payable as well. Scenario 1. On 28th March 2022, 10,000 shares of XY Limited, a listed company, are sold by Mr. B at 550 per share, and security transaction tax was paid at the time of sale of shares. These shares were acquired by him on 5th April 2017 at 395 per share by paying STT. So security transaction tax is paid at the time of purchase as well as at the time of transfer. So this will be guided under 112A. So hope you remember, under section 112A, if there is a transfer of shares, if the transfer of shares which is listed, then the gain have to be computed under according to 112A. So let's compute it together, friends. So the full value consideration here is, what is the full value consideration in this question, friends? It is 550 per share and 10,000 shares were sold. So full value consideration is 10,000 shares into 550 rupees per share, and that would be, so 10,000 into 550 per share, and that would be 55 lakh rupees is the full value consideration. Then let's see whether there is any direct expenses on transfer. First of all, friends, STT paid at the time of sale or purchase, whatever it is not allowed as a deduction under section 48. So under section 48, you cannot claim STT paid never as a deduction. That's it. Now, is there any other direct expenses on transfer? No. Normally, the direct expense that may come in is a brokerage. So there is no direct expenses in the transfer. So the net sale consideration would be the same, 55 lakhs. From that, you can claim what? Cost of acquisition. All right. Now, let's compute the cost of acquisition, friends. It was acquired on 5th April 2017. So, friends, hope you remember, if a particular share is purchased on or before 31st January 2018, then while determining its cost of acquisition, there is a special method. Hope you remember. So how to determine the cost of acquisition? You take either the actual purchase price, you can take it, or you can consider lower of the full value consideration on its transfer, or the fair market value of the shares as on 31st January 18. So you take lower of these two and you compare it with the purchase price, and whichever is beneficial, that simply means whichever is higher can be taken as the cost of acquisition. So let's compute the cost of acquisition in the proper manner. So what is the purchase price in this question? So purchase price in this particular question, let's take out the purchase price. It has been purchased for 395 per share by paying STT at the time of purchase. So 395 rupees is the purchase price. All right. Now let's take the full value consideration at the time of transfer. The full value consideration at the time of transfer was 550 rupees per share. Now let's find out the fair market value as on 31st January 18. So let's compute the fair market value as on 31st January 18. It is given in the question, the fair market value of the shares on 31st January 2018 is 390 per share. So it is also given directly, 390 rupees per share. So you compare these two and take the lower figure. So which is the lower figure? It is 390 rupees per share. Then you need to compare it with the actual cost of purchase, and whichever is higher can be taken. And the higher would be obviously 395 rupees per share. So 395 rupees per share into 10,000 shares were purchased. Yes or no? So 10,000 into 395, it would be 39,50,000. So 39,50,000 would be the cost of acquisition of this particular shares. So then what will be the gain, friends? Minus 55 lakh, and that would be 15,50,000 rupees is the capital gain taxable as per this particular question. Now friends, this is the long-term capital gain under section 112A. Now friends, under section 112A, hope you remember, over and above 1 lakh gain only will be subjected to tax at 10%. So the tax liability, here would be 15,50,000 minus 1 lakh. That is 14,50,000 into 10%. That would be 1,45,000 rupees will be the basic tax liability plus cess at 4% would come. So cess at 4% means 1,45,000 into 4% cess would be 5,800. So by adding that, the total tax liability would be 1,50,800 will be the tax liability here. I hope part A is absolutely clear for you. There is no need of any confusion. It's a direct question. It's an easy question as well. Now, moving forward. So part A carries 2 marks. Okay, it's a wonderful opportunity. It's a simple question and carries 2 marks. Now, let's solve part B. Mr. A is the owner of a residential house which was purchased on 1st September 2016 for 9 lakh. So the purchase price is given and he sold the house on 4th September 21 for 19 lakh and the valuation as per the stamp value authorities was 45 lakh. He invested 19 lakh in NHI bond on 21st March 2022. So let's compute the capital gain in this scenario. And friends, one more thing. While computing capital gain in the 112A, assessee is not supposed to claim indexation. So indexation benefit is also not available for the assessee. Hope it is clear for you. Now friends, let's move on. So it says there is a transfer of what? There's a transfer of a capital asset, that is some building, right? Residential house property. It has been transferred for 19 lakh on 4th September 2021. So the sale was on 4th September 2021 and the actual sale amount was 19 lakh. But you know, under section 50C, if an assessee is transferring a long-term capital asset or a capital asset, whether it is long or short, a capital asset being a land or a building for a value which is less than the stamp duty value, then stamp duty value shall be deemed to be the full value consideration. And for that, you have to check one more thing, whether his stamp duty value is more than 110% of his actual consideration. That also have to be checked. Then only 50C will be applicable. So what is the actual consideration in this question? 19 lakh. So what is the 110% of this 19 lakh? Let's check, friends. 19 lakh into 110%, it would be 20 lakh 90,000. But the stamp duty value as per the stamp valuation authority in this question given is around 45 or something. Yes, yeah, it is 45 lakh. So it is way high compared to the 110% of actual consideration. So under section 50C, the full value consideration shall be what? This 45 lakh. The stamp duty charges 45 lakh will be the full value consideration, and hence we can write 45 lakh will be the full value consideration on this particular question. Now here also there is no direct expenses on transfer. So the net sale consideration would be the same 45 lakhs. All right, super. Now from the net sale consideration, you can claim what? Cost of acquisition. So what is the cost of acquisition in this question, friends? So it says that it has been purchased on 1st September 2016 for 9 lakh. So it is purchased on 1st September 2016 for an actual amount of 9 lakh. So being a building, the assessee is definitely eligible to claim what? Indexation benefit. Now friends, what is this indexation benefit? To compensate with the time value of money. While computing long-term capital gain, an assessee from his cost of acquisition can take out the benefit of indexation. Yes or no? Now how to compute this indexation? The actual cost of purchase into multiplied by the index number in the year of transfer divided by index number in the year of purchase. So year of transfer means 2021-22. Let's check what exactly is the index number in the year 21-22. It would be 3,17,000. So 317 is the index number that have to be multiplied. And what is the cost of purchase? It is 1617 is the cost of purchase. Sorry, year of purchase, right? So in 1617 index number is 264. So divided by 264, what is the indexed cost of acquisition, friends? 9 lakh divided by 264 into 317. That would give him 10,80,682 rupees as the indexed cost of acquisition. All right. Now the question also says assessee has invested what? Invested 19 lakh in NHAI bond on 21st March 2022. So hope you remember under section 54EC, if there is a long-term capital asset being land or building, and the assessee has invested what? Invested the gain in NHAI or RECL or specified bond, that means 5-year these bonds, then assessee can claim an exemption under 54EC provided he need to invest this amount within 6 months. Within 6 months from the date of transfer. Hope you remember, under 54EC, if there is a transfer of a long-term capital asset being a land or a building, and the assessee has invested that gain in NHAI, in a 5-year bond of NHAI or Rural Electrification Corporation or other 5-year specified bonds, then assessee can claim that long-term capital gain as an exemption under 54EC, maximum up to 50 lakh. But the condition is, assessee, if he wants to claim 54EC exemption, he must invest that amount within 6 months from the date of transfer. Now, which is the date of investment, friends? It has been invested on 21st March 2022. So, the date of investment in the question is 21st March 22. And what is the date of transfer, friends? The date of transfer is 4th September. So, 4th September, that means October, November, December, January. Sorry, we will count it again. October, November, December, Jan, Feb and March. So, before 4th March, he need to invest in 54EC NHAI bond. Yes or no? Now, but the point is he has invested on 21st March 2022. So, the 19 lakh is invested after 6 months. Hence, he is not eligible to claim any exemption from the long-term capital gain. So, ultimately the taxable LTCG under section 112 would be 45 lakhs minus 10 lakh 80,682, and that would be 34 lakh 19,318 rupees will be the amount. From this, the rate of tax is at 20% plus 4% cess also will come. So we'll compute the basic tax. So the basic tax would be 20%. It would be 6,83,864, and the cess amount of 4%, that means 6,83,864 into 4%, it would be 27,354. That we will take it as 355, and by adding that it would be 77,11,219 would be the total tax liability in this question. So this is also a very simple, straightforward question where you can score easily 4 marks. I hope this is also clear for you. Alright friends, so moving on to question number 6. So let's understand what exactly is question number 6. So Mr. Patel is a proprietor of Star Stores since 2019, and he transferred his shop by way of slump sale for total consideration of 40 lakh being the fair market value of that unit. So this question is in relation to section 50B of income tax, that is slump sale. So friends, what do you mean by slump sale? I'll give you an example for slump sale. Say for example, I have a business, I have a running business, and all of a sudden I'm planning to sell my business. It is not in any amalgamation or a demerger. I'm planning to properly sell my business to some other party for a consideration. Alright? So when I'm selling my business to some other party, what happens is, during the transfer of business, there is actual transfer of different assets in the particular business. Say for example, there will be building, plant and machinery, furnitures, car, etc. of a business is getting transferred as a part of this business sale. Yes or no? And if this entire business is transferring for a lump sum amount without assigning individual values to different assets, then it will be impossible for the transferor to compute capital gains for each and every assets which is getting transferred as a part of this business sale. Yes or no? Because if we are getting a lump sum consideration for this transfer, the transferor won't be able to compute capital gain for each and every transfer. In that scenarios, section 50B comes to the rescue And they say you treat that entire business as a single asset. You treat that entire business as a single asset. Then you compute what? Capital gains. So that's what section 50B is all about. Now, under section 50B, there are three kinds of assets. So we can say in 50B, we compute the capital gains like full value consideration minus direct expenses on transfer. Thereafter, we will get the net sale consideration. From the net sale consideration, we can deduct cost of acquisition. And in 50B, cost of acquisition means net worth of that particular building. All right. And full value consideration means the fair market value of that particular business. So, as a part of February 2021 annual budget, Income Tax Act has come up with a new amendment under 50B. It says that from 1st April 2021 onwards, the slum sale, full value consideration on account of slum sale shall be deemed to be the fair market value of that particular business transferred. That's what they're saying. Now, the net worth, how to compute net worth? For computing net worth, you can take the total assets minus outside liabilities. This is the equation for computing net worth. Now, while computing total assets, in income tax, there are three kinds of total assets. Number one, depreciable assets are there. For that, you can take the WDV value as per Income Tax Act. And there are assets where 100% deduction is already allowed. Say, for example, if it's in the case of specified business and all, their capital asset, already 100% deduction is allowed under Income Tax Act. For such assets, you have to take the cost as what? Nil. And for other assets, say for example, debtors, bills receivables, bank, etc., you can consider the book value itself. This is what the Act says. So, while computing total assets, depreciable asset, you must consider the WDV value. The assets where 100% deduction is already allowed, those category you can take what? You can take nil value. And for other assets, you can take the book value. And outside liability, always you have to consider the book value of assets. So this is how we compute net worth. So you can deduct the cost of acquisition and you will get what? Either long-term or short-term capital gain. This is what 50B is all about. This was a quick revision of 50B. All right. Now, friends, let's read the question. Let's complete the question now. The professional fees and brokerage paid for the sale is 80,000 and his balance sheet as on 31st March 2022 is as under. So what it says is on capital is there, bank loan is there, trade creditors and unsecured loan is there, building is given, furniture is there, debtors is there, other assets is also given. No individual value of asset is considered in the transfer deed. That is without assigning individual value to the asset. This states that it is slum sale which is mentioned under 50B. Now, other assets include trademark valuing 2 lakh as on 1st April 2001 on which no depreciation has been provided. So in the other assets, they have included trademark also, which is purchased on 1st April 2001 for 2 lakh and they forget to claim depreciation on that. So basically trademark is a depreciable asset and the rate of depreciation for trademark is at 25% being an intangible asset. So they have accidentally included trademark also as a part of other assets and they forgot to claim depreciation. So what you need to do? You need to claim the depreciation and you need to remove the depreciation and you need to take only the balance WDV for computing the total asset value. Now, adjustment 3 states that furniture of 1,50,000 purchased on 15/11/2021 on which no depreciation has been provided. So furniture, it contains a value that is 1,50,000 is there where they forgot to claim depreciation which is purchased on 5/11/2021. And they are also saying unsecured loan includes 50,000. So this unsecured loan also has some further adjustment. It has 50,000 as advance received from his wife, which she has agreed to waive off. Compute the capital gain for assessment year 22-23. And you are supposed to compute the capital gain for 22-23. And this question carries 4 marks. So friends, this is a very easy direct question. And let's solve the answer without wasting the time. So we'll start with a full value consideration as always. So what exactly is the full value consideration in this question, friends? The full value consideration of this question being the fair market value, that is 40 lakhs. It's directly given in the question. That is the FMV, that is 40 lakhs. Now, is there any direct expenses on transfer? The answer is yes. Direct expenses on transfer is 80,000 being brokerage. So 40 lakh minus 80,000 will be 39 lakh 20,000 will be the net sale consideration would be 39 lakh 20,000 rupees will be the net sale consideration. Now friends, now let's compute the cost of acquisition, that is the net worth of this particular business. So let's compute the net worth by adding a working note to this. So for computing net worth, you need to compute total assets value first. All right, so let's go and compute the total assets value. Now, starting with the building, it says 5 lakh and there is no further adjustment for building. So we will consider building and we'll take the value as what? 5 lakhs. So here friends, we don't know whether this 5 lakhs is WDV value or it is a book value, but we don't have any further information. So we are assuming that this 5 lakh is what? WDV value, because building is definitely a depreciable asset. And according to the provisions of income tax for a depreciable asset, we always must take the WDV value. Here we don't know whether it is WDV value or whether it is book value. There is no further information. So we take 5 lakhs as the WDV value. We are assuming that 5 lakhs is WDV value. I hope you got my point. Now moving on to furniture, there are some additional adjustments. That is adjustment number 3. Furniture, the total value is 5 lakh. But on this 5 lakh, there is a 1,50,000 value which is purchased in this 21-22 year on which no depreciation has been provided. So on this 1,50,000, they forgot to claim depreciation. So furniture being a depreciable asset, you always have to take the closing WDV after removing depreciation. So on this 5 lakh, you first remove this 1,50,000. And how much is the remaining furniture value, friends? 5 lakh minus 1,50,000, it will be 3,50,000 is the remaining value of furniture. On this 1,50,000, you charge depreciation, then take the WDV value. All right. So we can take furniture 5 lakhs is the value. From that, we are removing additions in that year where we forgot to claim depreciation. That is 1,50,000 we are removing. So the remaining figure will be only 3,50,000. On that 1,50,000 furniture, that is furniture which is purchased on 5th November 2021, right? On that 1,50,000, you need to claim what? Depreciation. What is the rate of depreciation? Normally it is at 10%, but 5/11/2021 is the date of purchase. That means he has put to use that furniture for less than 180 days in the year 21-22. Yes or no? Because if an asset is purchased in the first year of purchase, if an asset is put to use for less than 180 days, then the rate of depreciation shall be 50% of the normal rate of depreciation. Hope you remember, we have discussed it under section 32 of income tax. Now, what we can take is only 5% as the effective depreciation. So 5% effective depreciation would be 1,50,000 into 5%, that will be 7,500 will be the effective amount of depreciation. After removing that, the value of that additional furniture will be 1,42,500 will be the value. All right. Now, which is the next asset? So we have considered furniture also. Next is debtors. You can take straight away the book value. So debtors, we will take the book value straight away without any further confusions. Now, again, which is the next asset? Sorry, it is other assets. All right. So other assets also, there is some further adjustment. It says in other assets, it includes trademark valuing 2 lakh, which is purchased on 1/4/2021, on which no depreciation has been provided. So he also forgot to claim depreciation on trademark as well. So as you know, trademark is depreciable at what rate? At 25% rate of tax, sorry, at rate of depreciation. So what you can do, first you will remove, let's remove that 2 lakh from the other asset value. Other asset total is 8 lakh and patent is, how much is the patent value? It is 2 lakh we are removing from this, and the net value of other assets would be only 6 lakhs. Then now let's compute patent. Patent 2 lakh is the purchase value, and we have to remove depreciation for the year 25% for the year 21-22. And what will be the depreciation on 2 lakh into 25%? It would be 2 lakh into 25% would give you 50,000 rupees as the depreciation. We have to remove this 50,000 depreciation, and 1,50,000 will be the closing WDV value of this particular asset. I think all the assets is, that's the end of all the asset value. So we will compute the total asset value. total assets value. How much is the total assets value, friends? Let's compute it together. 5 lakh plus 3,50,000 plus 142,500 plus 2 lakh plus 6 lakhs plus 1,50,000 will give you 19,42,500 as the total assets value. Yes or no? So it will be 19,42,500 will be the total assets value. Let's mark it down. All right. Now friends, it's not yet over. We have to compute the outside liability also. So outside liability, let's compute the outside liabilities also. So friends, tell me which all are the outside liability. It is bank loan, that is 5 lakh, there is an outside liability. So we'll write bank loan. Bank loan, the amount is 5 lakh. Now, which all are the other outside liabilities? Then there is trade creditors, 2,50,000. You can take the book values. Trade creditors, 2,50,000 is there. Now, which is the next outside liability? Unsecured loan, and there is some further adjustment for unsecured loan. It says out of this unsecured loan of 2 lakh, 50,000 was an advance given by his wife, which has been agreed to waive off. Okay, so out of that 2 lakh unsecured loan, there was an advance given by his wife, and the wife now is saying she don't want that advance back. She is waiving off that 50,000. Now, if wife is waiving off that 50,000, from the moment of waiver onwards, that won't be our liability. Yes or no? Say for example, you owe me 1 lakh. Today I'm saying I don't want your 1 lakh anymore. Then what happens? From that moment, your liability, you have a liability to pay 1 lakh to me, right? When I'm saying I don't want your 1 lakh anymore, at that moment, what happens? Your liability will come to an end. Yes or no? Likewise, the 50,000 rupees advance waived by wife of that person will not be considered as a liability anymore from the date of waiver. So what we can do? We can remove that 50,000 from the 2 lakh value. So unsecured loan total amount is 2 lakh. Then waiver of loan 50,000 from wife is there. That after removing that waiver, the unsecured loan will be only 1,50,000. And now you tell me what is the total value of assets. 5 lakh plus 2,50,000 plus 1,50,000, it would be 9 lakh would be the total value of assets. Yes or no? 9 lakh will be the total value of assets. So 9 lakh is the total value of outside liability, not assets. I'm sorry, it's outside liabilities. So now our duty is to find out the net worth. So how to find out net worth? Net worth means total assets minus outside liability. That is 1942,500 minus 9 lakhs. And the value would be 10,42,500 would be the net worth of that particular company. So we will write down that 10,42,500. Now friends, there is one question. Whether this gain is long term or short term, because capital gains, there are two types of gains. Either it can be long or it can be short. Now in slump sale, how will we determine whether the gain is long or short? It is based on the period of commencement of the business of that particular person. Say for example, this business is started on 25/2019. All right. If that business is running for more than 36 months, then the gain would be always long-term capital gain. If the business was running for less than 36 months, then we can say it is what? It is a short-term capital gain. Here we don't know when the sale is. Maybe the sale is on 1st April 2022. That's why they are given balance sheet on 31st March 2022. So the 1st April 2022 and 25/2019, it is 2019, 2020, 21, 22 May. At that moment only it will complete 36 months. So the gain would be definitely short-term capital gain here, because you have to always count from the date of commencement of business to the date of sale. If that period is more than 36 months, then we will consider it as a long-term gain. Otherwise, it always will be a short-term gain. So here it will be anyways short-term capital gain, and the gain would be 39,20,000 minus 10,42,500. It would give you 28,77,500 rupees as the long-term, short-term capital gain. 28,77,500 rupees will be the short-term capital gain. And that is the final answer to this question, and it carries 4 marks. It is only an easy question. I hope it is super clear for you. Alright friends, now let's move on and discuss question number 7. Now it's time for us to discuss question number 7. So this question is in relation to clubbing. Alright, so let's discuss this question number 7. Mr. Dharmesh, who is 45-year-old, and his wife Mrs. Anandi, who is 42-year-old, furnish the following information. So there are some information in relation to Mr. Dharmesh and Mrs. Anandi. Alright, so what your duty is to compute what? It's to compute the total income taxable in the hands of Mr. Dharmesh and Mrs. Anandi. That is your duty in this question. So let's compute the total income of Mr. Dharmesh and Mrs. Anandi. Alright. So yes, we will compute the total income together. So I'll read the question and I will write the answers straight away. So Mr. Dharmesh and Mrs. Anandi. Alright. Okay, super. Now we will start solving this question, friends. So yeah, there is one more thing before this. We will write it over here. Alright. So listen, friends. Let's read this question together. The salary income computed of Mrs. Anandi is 9,60,000. It said computed. What do you mean by computed? Computed means all the adjustment in relation to salary head have been already given, and the net taxable salary would be 9,60,000. That simply means they have deducted standard deduction, they have deducted entertainment allowance deduction, professional tax payment, etc. They have done everything which is required to be done. So the net taxable salary is 9,60,000. That is the meaning of this word computed. All right. So salary income of Mrs. Anandi. So we'll write salary of Mrs. Anandi is how much? 9,60,000. Super. Then what is the next adjustment? Income of minor son A, who suffers from disability specified in section 80U. So friends, please listen. In clubbing provisions, there is a provision. It states that if your minor son or daughter has some income, that always have to be clubbed with the income of their parents. All right. But there are certain exceptions. If the minor son or daughter earns income by using their skill, expertise, talent, manual labor, etc., then clubbing provisions will not get attracted. Or if the minor son suffers from any disability which is mentioned under 80U, then also what? Clubbing is not required to be done. So here their minor son A suffers from disability and he has an income of 3,08,000. Now you tell me, friends, whether this 3,08,000 is required to be clubbed with the total income of parents. The answer is no, because this minor son definitely suffers from disability and clubbing provisions will not get attracted. So we'll write son A disabled. We will write 3,08,000 rupees will be accessible in his own hands. We don't know what exactly is the nature of income. We will only write income. Right? Now, moving on to the adjustment 2, it says income of minor daughter C from script writing for television serials. So they have a minor daughter C and she is writing scripts for some television series. Now you tell me, friends, whether this income of this minor daughter C is required to be clubbed with the income of parents. Again, the answer is no. Why? Because as I've told you, normally the minor incomes will get clubbed with the income of parents. But here, minor daughter C earns some income on account of her own skill or talent. In that case, clubbing provision will not get attracted. I hope that point is also clear. So we will write this income has to be assessed in the hands of minor daughter C itself. That is 1,86,000. Just like professional income. It is not clubbed with the income of parents. Now, income from garment trading business of Mr. Dharmesh, 17,50,000. So, Mr. Dharmesh has some garment trading and the income is 17,50,000. So, we will write it as income of Mr. Dharmesh. So, professional income. Business income. Business income is 1,86,000. That is of Mr. Dharmesh. Now, cash gift received by minor daughter C on 2/10/2021 from the friend of Mrs. Anandi on winning of story writing competition, and the amount is 45,000. So friends, under 56 subsection 2 clause 10, any value of money received as gift will be taxable in income tax only if the aggregate value of money gift received is more than 50,000. Hope you remember. Under section 56 subsection 2 clause 10, if any person receives any money without consideration and the aggregate value of money received is more than 50,000, then only 56 subsection 2 clause 10 will come into picture. Here the aggregate amount of money received by minor daughter C is only 45,000 and it is not assessable under Income Tax Act. It is not taxable under 56 subsection 2 clause 10. If an income is not taxable, then you don't need to apply clubbing provisions as well. Hope you got my point. So here definitely clubbing provisions will not come into the picture. Why? Because that income of 45,000 is not at all accessible in income tax. Hence no clubbing required. You need to write notes for this. That's it. You don't have to adjust it to the main computation. Only write notes. Now moving on. Income of minor son B from scholarship received from a school, that is 1 lakh rupees. So this 1 lakh is on account of some scholarship received from school. So friends, this scholarships, educational grants, etc. received will be exempted under section 10(16) of Income Tax Act. You can refer chapter 3, that is exempted income chapter, or income which do not form part of total income chapter. Under that, there is a section called section 10 subsection 16. It says that all the scholarships etc. granted to meet the cost of education of a child is fully exempted. All right. Now this particular scholarship of 1 lakh hence will be fully exempted. If that income is exempted, then you tell me whether it is required to be clubbed with the income of parents. The answer is an absolute no. If that income itself is exempted, then what is the requirement of clubbing? All right, so clubbing provisions here also will not get attracted. I hope that too is clear for you. Now, adjustment number 7, income of minor son B from fixed deposit with Punjab National Bank made out of income earned from scholarship. So, the scholarship income is exempted, but Mr. B has, that means the minor son B has deposited the scholarship in a fixed deposit. From the fixed deposit, he accrues interest. Now that interest income accrued is definitely taxable in income tax. That interest income accrued is definitely taxable in income tax. Hence we can say this 5,000 is definitely required to be clubbed. Now another question. He has father and mother both are earning. His father and mother both are earning. So in whose hands this income is required to be clubbed, friends? So the thing which you have to check is what? You have to check is who has more income? Who has more income before clubbing? In that parent's hands, you need to add this amount. So let's check. Friends, there is one correction actually is there. So income from trading business of Mr. Dharmesh is 17,50,000. Okay. Here I think I've written 1,86,000. So it is 17,50,000 rupees the income of this person from business. I have accidentally written it as 1,86,000. That was a mistake. All right. So I'm really sorry for that. And now let's continue. Now let's check in whose hands this 5,000 is required to be clubbed. So tell me friends, Mr. Dharmesh has 17,50,000 and Mrs. Anandi has 9,60,000. So definitely income have to be clubbed with Mr. Dharmesh. So income from fixed deposit. And how much is the income, friends? It is 5,000 rupees. Yes or no? 5,000 have to be clubbed in the hands of Mr. Dharmesh. But under section 1032, hope you remember, if minors' income are clubbed with parents, then that parent can claim an exemption up to 1,500 rupees per minor child. So when clubbing provisions are attracted on account of minors' income, then that parents in whose hands that income is clubbed can claim an exemption under 1032, and the maximum amount of exemption is 1,500 rupees. So you can deduct, you have to deduct this 1,500 from this 5,000. Only effectively 3,500 rupees is required to be clubbed in the hands of Mr. Dharmesh. So 17,50,000 plus 3,500, the total income of Mr. Dharmesh as per this question would be 17,50,000 53,500 rupees. And the total income of Miss Anandi would be 9,60,000 itself. Alright, and that is the final answer. And Mr. A, disabled son A, has a total income of 3,08,000, and minor son C has a total income of professional income of 1,86,000 as well. So that is the final answer to this question. You are required to compute the total income of, basically the question demands compute the total income of Mr. Dharmesh and Mrs. Anandi. So you can compute the total income of Dharmesh, that will be 17,53,500, and Mrs. Anandi, that will be 9,60,000. I hope this is also clear for you. Again, carries 4 marks. All right. So this is a super easy question. Only a few things are there. You can adjust and write notes for those things, and you can compute the answer as well. I hope that too is super clear for you. Alright friends, now it's time for us to solve question number 8. So let's solve question number 8 together. So question 8 says, Mr. X, a resident individual, submits the following information relevant to the previous year ending 31st March 2022. So what are the particulars? Income from salary is there, income from house property is there, profits and gains from business or profession is there, capital gains is there, IFOs is there. Determine the gross total income of Mr. X for the assessment year 22-23 and the losses to be carried forward, assuming that he does not opt to be taxed under 115 BAC. So he is not interested in claiming 115 BAC. You are supposed to compute the gross total income of this person. So from this question itself, it's very evident that this question is in relation to what? This question is in relation to your set off and carry forward of losses. All right. Now, before moving forward, friends, let me give you one simple tip. So if you want to get more updates of the CA Inter as well as CMA Inter, then don't forget to join my Telegram channel. That's a new Telegram channel for intermediate students. Its name is CAJK Inter DT, and the join link is given here. This is the join link. All right. And at the end of this video, I have given a QR code. You can scan the QR code and directly join the channel. So let's continue. So the point is, you need to compute the gross total income by applying the provisions of set off and carry forward. All right. And this question carries 5 marks. So friends, we will start solving this question by writing notes there itself. So we will write a format like this: particulars, amount. So the first amount column is actually for inter-source set off, and the second amount column is for inter-head set off, and the third amount column is the total net profit column. All right. So friends, yes, let's start solving this question. Starting from income from salary, it is computed. Computed means all the adjustment have been considered. That is 2,22,000 rupees. So we will write salary income and 2,22,000 rupees. Because for salary, there won't be any inter-source set off. And what is inter-source, friends? Inter-source means, say for example, from one single head, from one source you have income and another source you have loss. You set it off. That is said to be what? Inter-source. Say for example, under PGBP, you have textile business and you have fertilizer business. Textile business is in profit, fertilizer business is in loss. You can set it off. That is said to be inter-source adjustment. And there is inter-head. Inter-head means what? You have loss from house property, you have income from PGBP, you can set it off. And it is subjected to certain rules and regulations. All right. So let's solve this question. Let's continue on this question. Adjustment number 2, it is income from house property. So I'll write one note here: house property income. So house property, which are the house properties I have? He has a house in Delhi which is in profit 22,000. So house in Delhi, HP in Delhi, we will write, and there is a profit, there is an income of 22,000. I will write in the inner column. Then he has a house in Chennai, it carries a loss of 2,60,000. All right. So house property in Chennai, and how much is the loss? 2,60,000 is the loss. Now, what is the next house? He has a house in Mumbai as well. It carries a loss of 20,000. So house property in Mumbai, it carries a loss of 20,000. So we will put brackets for the losses. All right. So we can conduct an inter-source set off because we have 3 sources there. We can conduct an inter-source set off, and the total would be 2,60,000 loss plus 20,000 loss is there. Plus there is a profit of what? There is a profit of 22,000, and the net loss would be 2,58,000 rupees will be the net loss from house property head. Or we will do one thing, we will write it here. 2,58,000 will be the net loss from house property. After inter source set off, net loss from house property. All right. Now, let's continue writing, continue with the other adjustment. Profits and gains from business or profession, we will write PGBP here. So PGBP, what are the things we have? So starting with the first one, we have textile business and it has a profit of 18,000. So we'll note it down. Textile business. It's actually a normal business. It has a profit. How much is the profit from textile business, friends? It has a profit of 18,000 rupees. Now, what are the other adjustment? We have a cosmetic business. It has a loss of 22,000. That's also a normal business loss. So cosmetics, again normal business, and it incurs in a loss of 22,000. Perfectly okay, no problem for that. Now, then they have a speculative business. Speculative business means transactions where actual delivery is not taken, right? Speculation business is mentioned under section 73 of income tax, and it contains a loss. So friends, hope you remember, if you have speculative business loss, then you can set off that loss only with speculative business profit. All right. Speculative business loss is not ready for inter-source as well as inter-head set off. If you have speculative business loss, you must set it off only with speculative business profit. It is not ready for any inter-source as well as inter-head set off. So what we can do, we can take the speculative business loss 174,000. We can write it there. So speculative 1. And how much is the loss, friends? It is 74,000 rupees is the loss. And there is one more speculative business 2, and it carries a profit of 46. So speculative business 2, and it has a profit of 46,000. Now the point is, these two definitely you can set off. These two definitely you can set off because speculative business 2 is a speculative business profit and business 1, it has loss. So they can definitely set off. And the net loss from speculative business would be, we will write 46,000 minus 74,000. It would be 28,000 is the net loss from speculative business. All right, one second. We'll write it here. Net loss from speculative business 28,000. Net loss from speculative business has to be carried forward to the subsequent year. It have to be carried forward to the subsequent year. Why? Why? Because very simple, speculative business loss can only be set off with speculative business profit, not with any other profits. Yes or no? So there is no point in considering it again in this question. We can carry forward it to the next year. Now the question, how many years you can carry forward? To subsequent 4 assessment years according to section 73. According to section 73, you can carry forward it to the subsequent 4 assessment years. So that 28,000 is gone. Now you can set it off these two. This is textile business, normal business is there. Both are normal business. One has profit and one has loss. So 18,000 minus 22,000, it will be a loss of 4,000, right? So you can write that loss of 4,000 here. That is actually a normal business loss. Normal business loss is there. Okay, we can consider this normal business loss for inter-head set off. That is well possible. Normal business loss you can definitely consider for inter-head set off. That we will write over there. Now, let's continue reading that question. We have adjusted all the PGBP items. Now to the capital gains. So we'll write capital gains over here. Write capital gains here. Now friends, tell me, short-term capital loss for the sale of properties there, that is 16,000. He sold some property and he incurred some short-term capital loss, that is 16,000. So we'll write short-term capital loss. It's a normal loss. And how much is the normal short-term capital loss? It is 16,000. Super. Now, there is long-term capital gain from sale of property. It is 15,400. And there is some long-term capital gain that is also normal. Not any listed shares, etc., etc. It is also normal. That is 15,400. Now, let me ask you one question. Can you set off short-term capital loss with the long-term capital gain? The answer is yes. For short-term capital loss, there is no demands. The short-term capital loss is ready to set off against short-term capital gain or long-term capital gain. But friends, listen, if instead of short-term capital loss, if it is long-term capital loss, then long-term capital loss can be set off only against long-term capital gain, not with short-term capital gain. All right, long-term capital loss can only be set off against long-term capital gain. Here it is a short-term capital loss, then you can set it off with a long-term as well as short-term capital gain. You got my point or not? Hope you have covered set off and carry forward of losses. We have studied it in a very detailed manner. So we will set off both of this. 16,000 minus 15,400, that will be 600 as the normal short-term capital loss. That is the net short-term capital loss is 400 rupees. Now friends, the next question is, can you set off this loss from capital gains head with the other income? The answer is no. Loss from the head capital gains can be only set off with profit from the head capital gains. So what you need to do, you need to carry forward this particular loss also to the subsequent year, because we cannot set off this loss from any other head, and it can be carried forward to subsequent 8 assessment years. You can carry forward this to subsequent 8 assessment years. So AY, you can carry forward it to subsequent 8 assessment years as well. That's it. Now friends, it's not over 8 assessment years. Now that's the end of the capital gains item. Now we will rewrite the income from other source, IFOs. It is also computed. Income from betting. Betting means it is casual income. Income from betting, winnings from lottery, casual income. What is the treatment? Casual income is not ready to set off with any other loss. Casual income under interhead adjustment will stand like in an isolated manner. They will not be set off. They will not be ready to accept any losses. Or we can say casual income will not accept any losses. They are not ready to set off with any losses. So you can write casual income 34,000. Again, income from card games is also casual income 46,000. So you can write that casual income to the outer column, because they are not ready for interhead. They are not ready for inter source as well as interhead set off. All right. So we will write the casual income. First we will write IFOS. So under IFOS, the first one is income from betting. Income from betting. And how much is the income from betting, friends? It is 34,000. So I'm writing it in the outer column because they are not ready for any interhead as well as inter-source set off. So it is a casual income. Now, what is the next income? Income from card games. Income from card games. It is also casual income. So not ready to set off with any other heads of income. So we'll write this 46,000 also in the outer column. Now, what are the remaining items, friends? It is loss from maintenance of racehorses, 14,600. So as you know, if you have loss from owning and maintaining racehorses, then that loss can be set off only with profit from owning and maintaining racehorses. Hope you have studied the inter-source as well as inter-head adjustments. So loss from owning and maintaining racehorses, they are not ready to set off with any other profits. They will be they are allowed to set off only with the profits from owning and maintaining racehorses. So ultimately what happens, friends, you tell me, this particular 14,600 you have to carry forward straight away because they are not willing for any inter-source as well as inter-head set off. All right. So we will write loss from owning and maintaining racehorses. How much is the loss, friends? How much is the loss? The loss amount will be 14,600. 14,600. Again, you can carry forward it to the next year. Carry forward it to the next year. Subsequent 4 assessment years you can carry forward. Under section 74A. Under section 74A, you can carry forward it to the subsequent 4 assessment years. So that's it. I think we have considered every adjustment. Now we will go back to the computation again for the inter-head set off. Now, as you know, there is income from the head salary. There is income from the head salary. And Yeah, there is income from the head salary is there, 2,22,000, and there is house property loss is there, 2,58,000. As you know, house property loss will be what? They are ready for inter head set off only up to loss limit of 2 lakh rupees. The loss which is over and above 2 lakhs have to be carried forward to the subsequent years. Hope you remember section 71. So what you can do, up to 2 lakh you can set it off from the salary income. Up to 2 lakh of the house property loss. House property loss is ready to set off with the salary income. The remaining 58,000 house property loss have to be carried forward to the next assessment year. 8 assessment year you can carry forward. You can carry forward this 58,000 to 8 subsequent assessment year. So we have to set it off, and you can write 2,22,000 minus 2 lakh, it would be 22,000 will be the taxable income from the head salaries. So we have adjusted house property as well as salary. Now we have PGBP loss, normal business loss of 4,000. Is there any gain remaining? No, because you cannot set off this normal business normal business loss with salary income. And first of all, you need to consider that you cannot set off business loss and salary income. Hope you remember. Those who have followed my lectures, hope you know there is a family fight between whom? Between the business loss, PGBP loss, and the salary income. There is a family fight, I've told you. So due to this family fight, the PGBP loss is not allowed to set off with the income from salary head. So what you need to do, you need to carry forward this business loss ultimately to the subsequent years. Why? Because again, the remaining income is casual income. As I've told you, from casual income, nobody is allowed to set off any other loss. All right. So what you can do, this remaining 4,000, again, this also have to be carried forward to the subsequent year. Carry forward to subsequent year. You can carry forward to 8 subsequent assessment years. So that's it. You can carry forward to 8 subsequent assessment years. So 58 you have to carry forward, 4,000 also you have to carry forward. Now 4,400 we have already adjusted. Then there is no other adjustment required. We will write the total income of this assessee. So friends, you tell me what is the total income of this particular assessee. Let's compute everything together and let's find out the total income. So 22,000 income from salary is there, plus 34,000 income from betting is there, plus 46,000 is there. That is income from card games. So the total would be 1,02,000. 1,02,000 will be the total income for the assessment year 22-23, and the losses to be carry forward. We will write losses to be carry forward. We will write the list of losses that are required to be carried forward, starting from house property loss. 58,000 is there. So loss from the head house property, 58,000. You can carry forward it to the next year. Subsequent 8 assessment years you can carry forward. That is list number 1. And item number 2 to be carried forward is what? Loss from business. Normal business loss 4,000 you have to carry forward. So normal business loss 4,000 you have to carry forward to, you can carry forward it to 8 subsequent assessment years. Then what are the remaining items? Then we can say normal business loss we have told for 4,000, and speculation business loss 28,000. Third one is speculation business loss 28,000 also you can carry forward to subsequent 4 assessment years. Then what is the fourth list? Fourth item coming is short-term capital loss. Short-term capital loss you have to carry forward. The amount of loss is 400, right? 400 rupees you have to carry forward to subsequent 8 assessment years you can carry forward. Then the next is loss from owning and maintaining resources. Loss from owning and maintaining resources you have to carry forward. How much is the loss? 14,600. 14,600 is the loss. You have to carry forward it to 4 subsequent assessment years. So these are the list of losses to be carried forward. And that is the final answer to this question. I hope this question is super clear for you. All right, friends. So moving forward with the next question, which is the next question. It's a theory question, question number 9. So it's an easy question, friends. So enumerate the cases where a return of loss have to be filed on or before due date specified under section 139 subsection 1 for carry forward of losses. Also enumerate the cases where loss can be carried forward even though the return of loss has not been filed on or before due date. So they are asking you to enumerate the cases where you have to file return of loss within due date. So as under section 139 subsection 3, hope you know, if you want to carry forward losses under section 72, that is normal business loss, or under section 73, that is speculative business loss, or under section 73A, that is specified business loss, or under section 74, that is loss from the head capital gains, or under section 74A, that is loss from owning and maintaining resources. If you want to carry forward these 5 losses, you have to file your loss return within due date mentioned under section 139 subsection 1 of income tax. So this is the first thing that you should know. If you want to carry forward these set of loss, you must file your return within due date. So that is the first thing that they have asked. Enumerate the cases where a return of loss have to be filed on or before the due date specified under 139 subsection 1 for the carry forward of losses. So these are the situations. If you want to carry forward these 5 losses, you have to file your return within due date. A return of loss for that respective year have to be filed within due date, which is mentioned under 139 subsection 1 of the Act. Now, they also have asked, also enumerate the cases where losses can be carried forward even though the return of loss has not been filed within due date. So even if you have filed your return of income belatedly, you can carry forward loss from the head house property and unabsorbed depreciation. This is what we can say. So if the loss is loss from house property, or if it is an unabsorbed depreciation, you can carry forward this loss even if you have filed your return belatedly. What do you mean by filing your return belatedly? That means even if you have filed your return after a due date, you can carry forward these 2 losses. So that is the second part of the question. So this question carries 4 marks. It's a direct, simple question, and you can straight away grab 4 marks by writing this much of information. I hope it is super clear for you. All right. So moving on to the next question, that is question number 10. So what is question number 10, friends? Question number 10, they're asking, in the following cases relating to the previous year 21-22, the total income of the assessee or the total income of any other person in respect of which he or she is assessable under Income Tax Act does not exceed basic exemption limit. So it says that in the following cases, assessee's total income does not exceed basic exemption limit. And you are required to state with the reasons whether the assessee is still required to file return of income or loss for the assessment year 22-23 in each of the following independent situations. So in the following situations, assessee's total income is less than his basic exemption limit. And you are required to answer whether in the following situation assessee is required to file his return or not. So it is a simple direct question. Straight away we can finish it off. Number 1, Manish and Sons, a Hindu undivided family, sold a residential house on which there arose a long-term capital gain of 12 lakh, which was invested in the capital gains bonds under 54 EC, so that no long-term capital gain was taxable. So it says an HUF was there, some Manish and Co. There was an HUF, and they have transferred a long-term capital gain. They have transferred some building or some residential house, and they have some long-term capital gain of 12 lakhs. And they have invested the 12 lakhs in exemption methods, which is mentioned under 54 EC. That is 5-year NHAI or RECL bond. They might have invested this 12 lakh. And they have claimed this entire 12 lakh as exemption. And their ultimate total income is what? Nil. All right. Now the question is, is this Manish and Sons HUF required to file their return according to section 139 subsection 1? So the answer is, friends, normally if you are an individual HUF AOP, BOI, AJP, and your total income is less than basic exemption limit, if your total income is less than basic exemption limit, you don't need to file your return. But total income means, there's a definition for this total income. Here, total income means from the normal total income, you compute the normal total income and you add back chapter 6A deductions. You add back chapter 6A deductions and you add back exemptions under 54, 54B, 54F, 54DA, etc. You have to add back those exemptions under capital gains chapter, that is 54, 54B, 54F, 54DA, 54EZ, etc. Then you check whether the remaining total income, we can call it as adjusted total income. Then you check whether this adjusted total income is more than basic exemption limit. After adding back these two, if the total income is still less than basic exemption limit, then you don't need to file your return. But if after adjusting these two, if your total income is over and above your basic exemption limit, then you must file your return according to section 139 subsection 1. So here the total income was nil, but the assessee has claimed 12 lakh as an exemption under 54EZ. Yes or no? So we need to add back that 12 lakhs to find out the adjusted total income, and the adjusted total income would be 12 lakhs. So it is more than basic exemption limit. For a normal person, his basic exemption limit would be only 2,50,000. Yes or no? So this 12 lakh is definitely more than 2,50,000, and he is supposed to file his return according to section 139 subsection 1. I hope it is super clear for you. Alright, now moving on to the second situation. And friends, you tell me how many marks it has. The first alternative has 1.5 marks. Second alternative again has 1.5 marks. Third alternative has 1 mark. So it is a basically 4-mark question. Alright, so second one, what they are saying, Mrs. Archana was born in Germany and married in India. Her residential status under section 6 subsection 6 of Income Tax Act 1961 is ROR. So Miss Archana, we will call her Miss A. Alright, so Miss A or Mrs. A is a ROR, resident and ordinary resident in India. And what is her problem? She owns a car in Germany, which she uses for personal purpose during her visit to her parents that place in that country. So she has an asset in Germany. Alright, now the question, we don't know about her total income. Anyways, in all the following situation, assessee's total income is less than basic exemption limit. That's what the starting of the question says. So Mrs. Archana's normal total income, which is taxable in India, is definitely less than basic exemption limit, but she owns a car in Germany. Alright, now the question, if an individual being an ROR owns a foreign asset, then irrespective of income, she must mandatorily file her return of income according to section 139 subsection 1. So here Mrs. Archana owns a car which is in Germany. That means it's a foreign asset. Now in that situation, she must mandatorily file her return in India according to section 139 subsection 1 irrespective of her total income. This is what is the final answer of this question. So in this case, being a resident and ordinary resident and an individual, Mrs. Archana is mandatorily required to file a return in India according to 139 subsection 1. And friends, we can say an alternative view also. This is the first view. And in the institute's suggested answer, there is an alternate view also, and that is also acceptable. In the alternate view, it says that a movable car, it's actually a personal effect, though you don't need to call it as an asset. Alright, so according to the definition of capital asset, if an asset is a movable personal effect, then you don't call it as a capital asset. Alright, so based on that definition, the alternate view says that car cannot be called as a capital asset. Hence, she is not required to file a return. So there is an alternate view also. But in my personal opinion, you must consider the first view. That is, she owns a foreign asset. So 139 subsection 1 says only that thing. If a resident and ordinary resident individual in India owns a foreign asset, whether it is a capital asset or not, owns a foreign asset, she must file her return in India according to 139 subsection 1. So stick on to this view. And the answer, final answer in my opinion is what? She must file her return in India according to 139 subsection 1. I recommend all of you to follow this alternate view number 1. you don't need to answer in all permutations and combinations in exam. You can stick on to either of these views. Okay, in your exams, you can stick on to either of these views. You don't need to write both. I hope you got my point. Now, moving on to the third scenario, it is Sudhagar has incurred an expenditure of 1,20,000 towards consumption of electricity, and the entire payment of which was made through banking channels. So friends, Mr. Sudhagar's total income is less than basic exemption limit. But he have incurred an electricity expenditure of electricity in the year 21-22 is 1,20,000. So hope you remember, under 139 subsection 1, there was an explanation. If an assessee's total income is less than basic exemption limit, normally he is not required to file his return. But if the same person has incurred an electricity charges which is more than 1 lakh in that particular previous year, he must mandatorily file his return of income. So here, Mr. Sudhagar's total income is less than basic exemption limit, but he has incurred an electricity charges of 1,20,000, which is more than 1 lakh, and hence Mr. Sudhagar is also required to file his return as per section 139 subsection 1. That is the final answer to this question on or before the due date. All right, I hope that also is clear for you. It carries only 1 mark, so you can write it in 2 or 3 lines. That is more than enough. So I think friends, by this we have completed our discussion on this July 2021 examination, and I hope this is super useful for you. And friends, if you like this video, don't forget to share it with your friends and colleagues who are appearing for inter. And friends, thank you for watching this video. Stay blessed, take care, and before we close this video, let me share one more piece of information with you, and this is the QR code for my CA Inter DT Telegram channel. You can scan this code and directly enter into this particular Telegram channel for more updates and information. So thank you for watching my video. Stay blessed and take care. Bye-bye.